City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco.
That's right. Stock futures are mixed this morning as heavyweight Nvidia eyes a cautious comeback from a three-day skid. So let's get to it with the three things that you need to know this morning as you prep for the trading day. We've got Yahoo Finance's Jared Blickery, Madison Mills, and Alexis Keenan with more.
Shares of Nvidia up 3% in pre-market after a historic stock slide. The chipmaker experienced a three-day sell-off, resulting in shares falling nearly 13% over the period, representing a loss of over $400 billion in market cap. Now, Nvidia's moves bring the tech-heavy NASDAQ composite to its worst day since April.
Plus, investors await Friday's PCE report. This is the Fed's preferred inflation gauge. Now, this comes after inflation has cooled in recent months, but it's still above the Fed's 2% target. Treasury Secretary Janet Yellen told Yahoo Finance in an exclusive interview that she expects inflation to continue to trend downwards.
I do expect inflation to come down, and as we get into next year, I believe that inflation will go back to the Fed's 2% target.
Secretary Yellen also said she does not see a recession in sight. We'll unpack why.
And European regulators are going after a second big tech target this week. The EU antitrust authority says Microsoft is violating the bloc's antitrust laws by bundling Teams with its other business software. This comes just one day after the EU hit Apple with an antitrust claim, saying Apple's App Store was illegally preventing developers from steering customers towards alternate ways to buy their content.
Our top story this morning, shares of Nvidia rising, trying to regain some ground here pre-market. The stock off around 10% over the last 5 days, losing nearly $430 billion in value in market cap over the last 3 trading days. Now, Monday's declines alone, they fueled $200 billion in losses, Nvidia's biggest one-day slide since mid-April here. And here we're taking a look at that 5-day view here for Nvidia. Of course, one of the huge things that this comes back to is really some of the selling that we've seen from insiders that's come forward. But more largely here, much of the thesis may not have changed for those bullish investors that are out there with Nvidia.
Yeah, exactly, Brad. And I think that is the question that everyone is asking here this morning, because here you're looking at Nvidia, at least in the pre-market trading, regaining some of those losses that we've seen over the last several trading days. So we're looking at a rise of just about 3%. And I think investors are at home or at their desks asking themselves whether or not the narrative has changed at all in Nvidia, if we're going to see any sort of unraveling when it comes to the AI trade, or if this is simply profit taking and you, the investor at home, should be looking at this pullback that we've seen here over the last couple of days as a buying opportunity. And going through many of the notes that have been out here over the last several days from Wall Street, there is that tone saying that, hey, maybe you should be using this as a buying opportunity here for investors, given the moat, given the competitive, given the dominance that we have seen Nvidia here within the space over the last several quarters. So again, when you take a look at their most recent earnings print, it doesn't look like it is slowing down, their momentum slowing down anytime soon. So again, a bit of a give back here, and you're looking at losses of just over 10%. So again, at least my takeaway from the notes that I've been reading here over the last several days is many are arguing that, hey, this is a buying opportunity for investors at this point.
Semiconductors going to get their next test this week when Micron also reports earnings as well,
giving us a better picture of the overall chip sector here. All right, well, does Nvidia's slide show signs that the AI trade might be unraveling? We want to talk about that with Kenny Polcari. He is Case Capital Advisors managing partner, here to help us answer that question. Kenny, what do you think?
So I think it's way overblown. I don't think people need to be nervous about what's happening in Nvidia. They should not be surprised. The stock has done nothing but go up in a straight line. So a 13% pullback, yes, does represent a little bit of a sale. But quite honestly, you could see this thing drop another 5 or 8%. You know, if we saw a 20% pullback in Nvidia, I wouldn't be surprised at all. It's up 140% just this year alone. A lot of it driven by this AI theme and this AI mania, which, you know, on its own probably got a little bit ahead of itself. And so therefore, I would look at this, and I continue to tell clients, I would look at this as an opportunity, meaning take your time, be strategic. If you see further weakness, it's okay, because this is about This is a long-term story about the future. This isn't about today or tomorrow.
And so with that in mind, if we see continued profit taking in Nvidia, is that a head for the exit sign for some who have been holding it for an extended period?
No, because look, I'm a perfect example of that. I've been holding it for over 2 years. This selling does nothing. It's not going to cause me to sell. Oh my God, I got to sell my Nvidia, right? I'm just not doing it. Quite honestly, I would use this weakness as an opportunity. But you also have to understand there's a couple of things happening. We're at the end of the quarter, right? So it's a quarter marking period. So you get a lot of big asset managers that are trying to reshuffle and rebalance. They got to show that they own some, but they use some of the profits to reallocate to other sectors. Sure. And so this is just normal risk management, and that's what individual investors need to understand. Look, Vanguard's been a buyer going into this quarter, but Fidelity's been a seller. They're both large asset managers, but they're buying and selling for different reasons. Doesn't mean Fidelity's getting rid of their position. They're just trimming some of it, where Vanguard says we see even more opportunity, so we're buying. So you have to think like an institution.
And what is, I guess, the appropriate risk management then? If you're an investor at home, how much of your portfolio should be allocated towards Nvidia, towards chip sector? Because that's the big question.
Okay, so that is a big question. And I actually put this in my note this morning. Look, I'm 63. Nvidia is 13% of my portfolio. And some asset managers would say, oh my God, that's way inappropriate for you because of my age. Well, guess what? It's not inappropriate for me because I'm the one who made that decision. I'm comfortable with that level of risk. If you're a 30-year-old, you may want to have 40% in the AI trade because you've got 30 years to go. But if you're 70, you may want to have, a 5% or a 3% position because clearly you've got less time, and you don't want to risk it. So the answer to that question very much depends on who you are and where you are in the life cycle and on the risk scale.
I mean, we've tracked the run-up in Nvidia, but if you're rotating out of Nvidia, what are the other areas that look appealing right now?
Well, listen, if you're rotating out of Nvidia, but you want to stay
or at least reallocating some of the profits.
You want to reallocate them outside of tech, or do you want to, and take advantage of consumer staples or energy or financials, which are perfectly great sectors to rotate into, especially if you think that the AI trade is well ahead of itself, and we're going to see some pullback, and the market's going to hit a little bit of a rough patch over the summer, July and August, and maybe into September, which I actually think it's going to. So new money that I've been putting to work, I've actually not been chasing tech. I haven't been chasing, the AI trade, but I've been putting money into consumer staples, utilities. Utilities, the most boring sector in the world, is up 15% year to date.
A boring part of the AI trade, too.
That's exactly right. And so there's huge opportunity there. So listen, I'm in this camp that you can't let, especially stuff like Nvidia, because it's not a small cap, unknown company. It's very much at the center of where the world is going. So for people to go, oh my God, I got to sell my Nvidia. Listen, when Bloomie's has a sale and dresses go on sale for 30%, you don't go in and return your clothes. You buy more because it's on sale. Right?
Yeah, that's a fair argument.
It's a fair argument. And that's why when people say, especially with names like Apple or Amazon, it goes down 10%, and you go, oh my God, I got to sell my... No. That's the wrong decision.
So I think investors are also just taking a step back right now. They're trying to figure out where we are right now within some of that enthusiasm, euphoria that we've seen within the market. So we have Nvidia, we have that story, but then also moving on, some of the other catalysts that investors need to keep on their radar. When it comes to the Fed, when it comes to that PCE print that we're going to be getting at the end of this week, we've also got the Russell rebalancing. So what do investors need to know?
So the Russell rebalancing happens on the same day. And so what investors have to understand about the Russell rebalancing, just like the S&P rebalancing last week, is that it says nothing about the market. All it does is the Russell has rebalanced the weightings of these small and mid-cap stocks that are in their different indexes to reflect the movement. So it says nothing about the overall market. It's going to create volume because there's going to be shifts in names, but it says nothing to you as an investor about should I get out of this name or into that name. Not at all. The PCE, which is the Fed's inflation gauge, is something that people will pay attention to. And trust me, it is expected to be softer, which would be a positive. But you really have to turn around and look at yourself and say to yourself, am I really feeling this decline in inflation? When you go to the supermarket, when you pay your utility bill, when you get your insurance bill, are you really seeing prices come in? Do you feel any better about the inflation picture? And that's kind of where the investor has to where the rubber meets the road.
You were talking about where there might be sales coming forward here. What are the three? Are there three names that you hope there are sales in some of the stock price action that we've seen recently?
Certainly in the tech space is where I'd like to see a lot of sales. Nvidia is right at the top of my list, right? I said I would love to see Nvidia back off because I want to buy more, not only for me, but I want to buy it also for clients. But I didn't want to chase it. I mean, look at the chart. It goes like this. It's ridiculous. I'd like to see it actually come back to trend line support is where I think it could absolutely test, and then where I think you could start to get in, right? But other names in that tech space. So AMD's a name. Micron's going to be. We're going to hear from Micron, right? Yeah. So that's going to be a potential name. Even Intel is a name that suddenly seems interesting. Palantir is another name in the tech space, right? But away from that, like I said, I'm looking at the other sectors. I like consumer staples because if I think that there's going to be a little bit of a rough patch over the summer into the fall, it's the things you need versus the things you want, right? So you need, the staples are things you need. And so they continue to have some pricing power. And look, I think it's a safe place to put some money, still have exposure to the market. Some of them are very good dividend payers as well, so you get paid for owning it. Besides the fact, again, I'm 63, so it makes sense. If you're 22, maybe you don't want to be in consumer staples. Okay, great, I get it. But for me, and a lot of my clients, you need to have some stability and you need to understand what those different sectors represent in the broad portfolio.
All about a balanced approach.
Correct.
Kenny Kapolkari, always great to have you, especially here in studio. Thanks so much for joining us here today. All right, let's move on to another big story that we're watching. It's another setback for big tech. In regards to regulations, we've got the European Union, the EU, accusing Microsoft of breaking some antitrust rules with the bundling of its Office software and Teams products. Yahoo Finance's Alexis Keenan joining us now with those details. Hey, Alexis.
Hi, guys. Yeah, so right on the heels of this Apple news that we got yesterday, this is a similar statement by the European Commission. So different facts here, but the European Commission, the regulator in the EU, is issuing Microsoft a preliminary view. That's what it's called. It's basically a charge. It's called also a statement of objections. It all comes before a final decision. And what they claim is that Microsoft is bundling or tying its Microsoft's Teams product to other business software, namely Office 365 and Microsoft 365. They say that's a violation of EU antitrust rules. And the market that they've identified is SaaS productivity apps for business. So specifically in that business sector. And we knew all the way back in April that the EC was planning to make a charge, and these actual claims, these problems that Microsoft's competitors have with this issue go all the way back to 2020 when Salesforce's Slack complained that this was anti-competitive. So that then led Microsoft in 2023, in October last year, to unbundle Teams and Office. But the EU, the EC says they didn't go far enough. Microsoft then spread that out globally this year. But now Microsoft is going to get a chance to respond to these claims. But, you know, the EU, the EC's process, it's administrative. It's really different when the EU makes an antitrust claim against a company. In the US, we're familiar with the DOJ or the FTC bringing a complaint, going through a trial, perhaps, going through negotiations, a lawsuit, right, in a court of law. But in the case of the EC, it is the investigator, it's the judge, it's the jury, and the fines can be very, very steep in the EU. They're up to 10% of global revenues. They can be up that high. And for Microsoft in 2023, we're talking about annual global revenues of $212 billion. So if it were a violation were found and a fine that high was assessed, we would be talking about $21 billion. So no small change. So the EC taking its antitrust laws very seriously here. Once again, we're seeing evidence of that. In response, Microsoft has told Yahoo Finance that having unbundled Teams and taken initial interoperability steps, we appreciate the additional clarity provided today, and they say they will work to find solutions to address the EC's remaining concerns. So Microsoft definitely saying they want to work it out here, and for good reason.
Who knew Teams would cause such the hubbub? All right.
Hubbub.
Thanks so much, Alexis, for breaking this all down. Major implications potentially there for Microsoft for sure here. We'll continue to track that. All right, everyone, we're also tracking investors shifting their focus to the next set of inflation data. PCE is on tap Friday. Over 60% of traders still anticipating a rate cut to come in September. Our own Jennifer Schonberger asked Treasury Secretary Janet Yellen in an exclusive interview about the path forward for inflation. Here's what she had to say.
I do expect inflation to come down, and as we get into next year, I believe that inflation will go back to the Fed's 2% target.
Our next guest is expecting a slightly slower route to that 2% mark. Michael Gapin, BofA Securities Head of U.S. Economics, joins us now. Michael, great to see you. Great to get some insight. You heard from the Treasury Secretary there. What are your anticipations as to when we could see us finally getting to that 2% target?
Yeah, I think we largely agree with what Secretary Yellen said. We think it'll come a little later. We think 2% may be achieved in 2026, not 2025, but we don't disagree with the trajectory. We do think inflation is coming down. What Secretary Yellen also noted in her interview that a lot of the stickiness about inflation was centered around housing and housing-related costs. Those are likely to be elevated for some time, but directionally, yes, we think inflation will come down. We do think it opens the door for a gradual rate cut cycle later this year. We just think things happen a little more slowly than Secretary Yellen suggested.
So would rate cuts then, if we were to see that later this year and even going into 2025, would that hinder being able to get to that 2% target by 2026?
Not necessarily, because the way that the Fed has laid this out is to say, yes, they would likely be reducing rates later this year, but the pace of rate reductions would be gradual. And the way they think about it is inflation has come down an awful lot. And in essence, you can cut interest rates and keep and preserve a real policy rate stance. So adjusted for inflation, the Fed's policy setting would be largely unchanged. So what essentially they would be doing is cutting rates to prevent policy from getting too tight over time. And so they can still guide inflation down to 2% from above, even though they're gradually reducing rates. So they'll maintain their existing policy stance by cutting interest rates gradually.
So, Michael, what does that then do just to the overall U.S. economy? We talk about the fact that growth is already moderating. Are you still confident that the Fed is going to be able to orchestrate a soft landing?
I do. Obviously, nothing's assured, of course, but we do think that every quarter that goes by, kind of every set of data we receive does increase the probability that the U.S. is achieving a soft landing, right? And the key there is essentially how much, to use the Fed's term, how much pain do you need to inject into labor markets? How much demand destruction do you need to create in order to bring inflation down? We haven't needed much of that. So every month, every quarter that goes by and growth is elevated and the unemployment rate stays low, but inflation comes down, I think the Fed is winning the battle in terms of creating a soft landing. Nothing is guaranteed, of course, but we do think it's the most likely outcome.
What would be the reality of the consumer environment and that need to move to in order for the Fed to see what it needs, both on the inflationary side, but also on the employment side as well, as many consumers just look back to the strength in employment to figure out how confident they are to continue to spend?
Right. So I think kind of the nuance with this whole story, of course, is we expect growth to moderate. We expect the catch-up effect in employment to slow as the services sector finally achieves the level of employment that it desires. So the rate of consumption growth should slow. The rate of economic growth should slow. These should all move back to more, quote, normal levels, which is around 2%, which is still plenty to keep the U.S. in an expansion phase and in a recovery. It just won't be the 3 to 4% or 5% real growth rates that we saw in prior years. So I think the outlook is a little less employment growth, a little less wage growth, but still enough adjusted for inflation to keep the consumer balance sheet healthy overall. But as you noted, the economy is cooling. It's just not cool overall. The labor market is cooling. It's just not cool overall. That's kind of the balance in here. We should expect things to moderate, but it doesn't mean the economy is weakening. It's just normalizing coming out of the pandemic.
All right, Michael Gapin, always great to talk to you. Thanks so much for making the time to join us here this morning. Bank of America's head of U.S. economics. Thanks so much. Well, we are just getting started here on Morning Brief. Coming up, Airbus shares plunging after slashing its 2024 guidance. We've got some of the top trending tickers for you next. And Treasury Secretary Janet Yellen telling Yahoo Finance that there's no silver bullet to lowering the cost of home buying. We'll speak to an economist later this hour. Plus, we lay out the 3 key factors that could drive the markets in the coming weeks. That's coming up in the 10 a.m. hour on Catalyst. We've got all that and more. You're watching Morning Brief.
Boeing is reportedly offering to acquire Spirit AeroSystems in a deal consisting of mostly stock, valuing the company at around $35 per share. According to Bloomberg, the deal reportedly originally an all-cash offer. This is significant, especially as you continue to really evaluate what this would mean for Boeing, trying to bring even more of a handle over its manufacturing operation. And of course, in Spirit AeroSystems, they also have operations that run directly with Airbus as well, a company that we'll be talking about a little bit more in a moment here. But Airbus is trying to get its, at least part of the Spirit AeroSystem manufacturing, and Boeing is going to end up with the more outsized share and the kind of lion's share of what Spirit AeroSystems is for their own manufacturing of its aircraft going forward here. But even as we're kind of looking at both of these businesses, Spirit AeroSystems stock has essentially been moving over the past several months over just this back and forth over what the price might be, what the deal might actually come down to at the end of the day.
Yeah, when you take a look at what the offer is and what exactly that means in relation to Spirit's stock price, now $35 per share price represents a premium of about 6% to where it closed yesterday, Monday's close, but 22% upside to its closing price on February 29th. And we talk about that day because this is a day before Boeing's takeover talks really started to become public. So we have seen a bit of a rise here. And again, Spirit AeroSystems now moving lower by about 3.5% here on the heels of this news. In terms of what Wall Street, what analysts are saying here, the early reaction to this, Stifel was out with a note to clients here today saying that as we await more details, but we do see the $35 per share mark as a reasonable outcome here for both parties. So obviously, Brad, like you said here, acquiring Spirit AeroSystems, it's going to give Boeing greater control over the manufacturing process here of its jetliner structures. We know obviously it has been under a tremendous amount of pressure to implement some changes here, to say the least, to its manufacturing processes in order to eliminate some of the issues here that it has had here over the last several months. But again, here we're taking a look at the reaction to this news, $35 here per share price, representing about a premium of 6% compared to where the stock closed, Spirit AeroSystems closed yesterday. Well, staying in the aerospace sector, let's talk about Airbus, because shares today are sinking off just about 12%. The company is slashing its 2024 guidance for earnings and deliveries, now expecting to deliver only 770 commercial aircrafts this year. That's a decline from the previous estimate of about 800. And taking a look at what exactly this means here for the company going forward, Deutsche Bank cutting its rating to hold following what it described as the quarter as a rather damaging warning here from Airbus. And we're also seeing this ripple effect here through suppliers. You're seeing a number of its suppliers here under pressure this morning. So clearly, the fact that they are cutting their guidance here, some of the supply chain issues continuing to be a real challenge here for the sector. And as a result, they are Airbus is far from the only stock here taking a hit on the heels of this news.
Yeah, I'm surprised to see some of the airline operators that are actually anticipating taking delivery of some of primarily the Airbus A320 family of jets, where that's been essentially pushed back in terms of the targets to produce 75 a month. That's been pushed back from 2026 to 2027 as part of this. They held a call with analysts where the chief executive had discussed engines not being an issue in 2023, and that at the beginning of 2024, again, becoming a significant issue. And so that is a new situation that they were not expecting here. They talked about cabin parts. They also talked about the engine maker, or kind of the wider aerospace sector here, the implications there, at least, that a lot of analysts were taking away from this. Some of the engine makers that would also be impacted, Rolls-Royce, that was being impacted as well. You saw their share prices following on this announcement too. But again, it's going to have a larger implication for a lot of the airline operators that were expecting to take delivery, that had already pushed out some of their targets because of the Boeing issues that were taking place. And call after call over this past earnings season, you heard each of the CEOs of airline operators talking about how tricky the manufacturing landscape has become and how much that's impacted the route scheduling, the number of pilots that they're able to then onboard and really move from training into full routes and full schedules. And then additionally, just what that means for their own revenue targets or even profitability targets in this near term too. So all of these things considered are going to be interesting when we do kick off the earnings season. Of course, some of those airlines might be prone to give some of those updates very early on. Delta's typically one of the first airline to really report and kick off the earnings season too.
All right, let's stick with the travel sector here, because we're also getting some earnings out from Carnival. Carnival shares moving to the upside, being on the top and bottom line, also raising its full year guidance. You're looking at gains of nearly 4% here. The call expected to get underway in just about 30 minutes from now. But here, going through what this report exactly shows in terms of demand remaining extremely resilient. You've got revenue up 18% on a year-over-year basis. When you take a look at occupancy, that's 104%, beating what the street's expectations were. When you look at passengers carried, that was 3.3 million, up 10% from a year ago, also surpassing the street's expectations. And when you take a look at those booking numbers here, the fact that we are seeing such demand, not only for its most recent quarter, but looking out to its fiscal third quarter, obviously the street very encouraged by some of the guidance numbers that we're getting out this morning too.
I'm just sitting here smiling, Sean. I mean, this company kept us on the edge of our ergonomic chairs coming into the start of today's show. We didn't know what time it was going to drop, but we knew it had to come out by 10 a.m. because that's when the call starts. But ultimately here, one of the things that kind of jumped out to me within this release, the company is saying based on continued strong demand trends, they're taking up their expectations for the year, with net yields now forecasted to top 10%, propelling them towards double-digit returns on invested capital. Their upwardly revised guidance, they're going to be on average about 2/3 of the way to achieving their 2026 sea change targets after just 1 year. So this is considerably noteworthy, and they think it gives them even more conviction in achieving some of those deliverables there. That coming from the company's executives who were expected to give even more commentary on the call, but that specifically was from their Chief Executive Officer, Josh Weinstein. Also here, just thinking about the net income, $92 million in this most recent quarter. So that is an increase of nearly $500 million compared to 2023 here when you think back to the losses that some of these cruise line operators were having to navigate through. Really choppy waters. I had to throw in a pun somewhere,
there
of course.
There you go. It was
easy.
perfect, and it landed. Seas. You nailed it. And when you take a look at some of their competitors as well, because take a look at that, when you the gains that we're seeing almost across the board on the heels of these results, from Carnival, you'll get Royal Caribbean up just over 1%, Norwegian up just around 2.5%. And we have seen strength across the board when it comes to bookings, when it comes to demand. And I also think the question coming out of the pandemic was not only whether or not these cruise liners were going to be able to win back the business, those loyal cruisers that we saw here pre-pandemic, but also what they were going to do in order to win that new business, those that hadn't taken cruises before. When you take a look at these results and compare them to the numbers that we saw pre-pandemic, they clearly have surpassed that.
All right, well, bon voyage on this trading session here today as we're taking a look at the opening bell where you've got Booz Allen Hamilton ringing the opening bell at the NYSE, ticker symbol BAH, BA, and Amphastar Pharmaceuticals. My goodness, the pharmaceuticals industry never knows how to just give us a straight name. Anyway, Amphastar, they kick off today's trading session. Some virtual and some real funfetti in the air there. That is the opening bell. You're watching the Morning Brief, brought to you by Invesco. Let's do a check of the markets as you've got major averages up on your screen. However, only 2 of the 3 U.S. major averages are indeed up. The Dow is the lone laggard. It's down right now by about 0.2%. S&P 500, though, and the NASDAQ, they're seeing some green. The S&P 500 up by about 0.2%. NASDAQ Composite tech-heavy average, you're seeing that up by about 0.5% here on the day. And, of course, we've got even more earnings that are going to be coming out over the course of this week, perhaps have the propensity to shift things. Get some household names coming out this week. I'm really excited about this, Shauna. Nike, FedEx, Paychex, General Mills, Carnival, we got them this morning. McCormick, for those who are seasoning their steaks when they're getting ready to grill, you got them reporting this week too, plus Walgreens Boots Alliance.
Yeah, we'll get another real read here on the consumer. We've also got consumer confidence coming out here at the top of the next hour at 10 a.m. Eastern time, giving us a closer look just at exactly what those spending levels or ability to spend confidence-wise looks like here. But also it's important to check on the movement that we're seeing in Nvidia here at the open, rebounding from those 3 days of losses. You're now looking at gains of just over 2.5%. Jared Blickery standing by with a closer look at some of today's action. Jared.
Yes, Shawno. Today we have the Dow and the NASDAQ heading in opposite directions yet again, except they've switched. Today the Dow is down about 64 points, NASDAQ up about 0.5%. But let me just show you a comparison over the last 5 days of the NASDAQ versus the Dow. And here's the NASDAQ in the green, here's the Dow in the red. And you can also see a bifurcation in the S&P 500 based on market cap versus equal weight, depending on how it's calculated. So the equal weight has been surging, and we had a big day yesterday. Meanwhile, the S&P 500 in the red over this time period. So just an interesting dynamic that we've been tracking here. So let's take a look at, by the way, this is a NASDAQ 100. We'll get to that in a second. First, I want to check out the tech sector. XLK leading here, that's up 0.6%. In fact, that's the only sector that's leading today. Everything else lagging. We do have communication services in a little bit of green there, but materials and industrials are the biggest losers, trading to the downside. And it's heading back to the NASDAQ. So we just came off that 3-day loss from Nvidia. You can see it's up about 2%, and it's switching positions with Apple here as I speak. But I wanted to concentrate for a second on Amazon. Just want to show you a 5-year chart. It is right back up to the Rubicon here, trying to build out of this or break out of this multi-year base. And if it can, it should have a lot of momentum to the upside. Just something to watch for. It's not there yet, but something possibly to watch for. Also, I want to close with biotech. IBB just broke to the upside. Biotech in the midst of a 3-day rally here. Let me see if I can find the chart. There we go. Up 3.1% over the last few days. Here's a 5-year chart again. It is just breaking above this potential resistance. So something to look out for in biotech is an upside surge past this resistance area, guys.
All right, something that we're going to keep an eye on here in today's trading day. Jared, thanks so much. We'll keep it right here on Yahoo Finance. We're going to take a look at oil. Crude prices moving just a bit lower today as the rally takes a breather. We're going to speak to one analyst on the other side about what stocks are best positioned right now within the sector. That's right after the break. Stick with us. Crude taking a breather from its recent rally. We've got prices giving back some of those recent gains this morning. You're looking at a drop at just about 0.5% here for Brent. Also, that move lower here for crude. Well, so far this month, though, it's been a bit of a different story. We have crude up over 4% as demand in the U.S. continues to grow, and also rising geopolitical tensions pushing prices higher. So where do we go from here? Here to discuss the best plays within the sector, we want to bring in Roger Reed. He's Wells Fargo's refining and integrated oil and gas senior analyst. It's great to have you. So let's first just take a step back before we get into those specific plays. Talk to me just about where you see the price of crude and Brent heading. Lots of speculation about whether or not we are going to see a bump higher driven by that demand this summer. What do you think?
Yeah, good morning. Thanks for having me on. Yeah, I mean, I think summer driving season should be fine, right? If you look in retail pricing, it's the most affordable it's been in 3 years in the U.S., and that's a huge component of it. You look at jobs, those are holding in fairly well. Mobility and jobs are tied together. And then, independent groups like AAA have said, they expected record levels of travel over Memorial Day weekend and again over the 4th of July. So everything looks pretty solid on the driving side. Diesel's been a little weak with the industrial side of the economy, but it's flat, not down as we look at it.
As we kind of look out to the next coming months here, I mean, there's going to be a lot of focus on what some of the international moves in terms of production are. What are your anticipations there for how that could also impact this run in the oil and gas sector?
Yeah, so the biggest thing to watch is how OPEC comes back into the market, or OPEC plus, as it's kind of now called, right? And they've stated, at their last meeting, they want to bring their oil back in, but that they, put a caveats on it. We want to bring it back in a way that doesn't upset the market. So they've kind of put a number, let's call it aspirational, and then they've got a number that let's call it the realist number, right? And what it says is OPEC wants to put more oil on the market. OPEC will put more oil on the market, but OPEC wants to do it in a rational way. The way we've been looking at the oil markets overall was, a year ago or so, we'd have said long-term 75 Brent, 70 WTI. Then with the OPEC discipline, we came up $5, kind of 75, 80. So oil today, 80, 85. If OPEC overshoots a little, bringing it back, puts a little pressure on. To us, that's still in the range of where things ought to be. But, how exactly it'll play out, you've got the Red Sea, you've got Ukraine tossing missiles into Russian refineries, you've got sanctions risk post-U.S. elections if Trump wins on Venezuela and Iran. So there's a ton of moving parts to it.
Roger, we also got the IEA issuing their outlook not too long ago. And my question to you is, I guess, how confident are you, or whether or not you agree, and what they are projecting when it comes to EV sales, that demand ticking higher, when it comes to the demand here for gasoline and oil peaking by the end of the decade? Is that in line with what you're seeing? Why or why not?
So first off, anybody who has to make forecasts, I feel for them, right? The IEA takes a shot at it, we take a shot at it. So, who's right, we'll see. We have been skeptical about the pace of EV penetration, almost back to the aggressive kind of numbers that were put out in the 2020, 2021 period. If you look, the most recent data out of Europe, Germany had to scrap subsidies due to some specifics of German law and tax and spend policies. And we saw German EV sales drop rather precipitously. And if you look at total EU sales, they're only at about 12% of total. So way below the targets they have. Now that's pure battery EVs, not hybrids and everything else. But what it tells me is any place that loses subsidies, even for a short period of time, is struggling to hit the targets. And so for that reason, we are skeptical of the numbers the IEA included, and therefore we have a longer timeline in terms of demand for oil and, in this case, gasoline, transportation, fuels. We think beyond 2030, you'll continue to have growth.
Yeah, and Roger, just while we have you here, I'm looking at a headline from AAA, and a lot of investors who are also consumers and buyers of gas trying to get from point A to point B, especially over these summer travel months, reading headlines like, despite the rise in temperatures, gas prices keep it cool. What is your anticipation for how this might all trickle down to prices at the pump?
Yeah, I don't know. For us, it's not so much temperatures. I guess you'd call it more rain or no rain in terms of whether people will drive. But yeah, the affordability thing, and we look at it a couple different ways, but one of the key ones is, what are wages and what part of wages are required to buy gasoline? Think of it as a ratio. And as I said earlier, that ratio is as favorable as it's been for this time of the year, going back to the summer of 21. And that would argue that all else equal, people will feel comfortable spending the money on gasoline and mileage. Now, there's other aspects of it, right? Broader inflationary pressures that can have some impact. But at least as we think about it from the cost of a gallon of gasoline, it's a serious incentive compared to the last two summers.
Roger, real quick, those investors at home that are watching the segment, they're trying to figure out what the best plays are, how to invest within the oil sector at this point. What are some of those top plays that you're looking at now?
Yeah, so we cover a pretty wide swath of the oil and gas space. So in the integrated oils, Chevron is our top pick. In what we call international E&P, Suncor is our top pick. In the refining space, Phillips 66 is our top pick. And then in the energy services space, that's a tougher one for us. But a U.S. onshore play, and Liberty Oilfield is our top pick there.
All right, Roger Reed, who is the Wells Fargo Refining and Integrated Oil and Gas Senior Analyst. Roger, great to have you here on with us today. Appreciate it.
Thank you. Glad to be here. See ya.
See ya. Coming up, everyone, a fresh read on the labor market. We'll break down what the data means for potential home buyers on the other side.
Welcome back to Morning Brief, brought to you by Invesco. We've got the latest reading out on housing this morning. Home prices rising 7% from a year ago, setting a new record high in April as the market remains tight. And higher home prices, well, they continue to exacerbate the nation's affordability crisis. In an exclusive interview, Treasury Secretary Janet Yellen had this to say about the housing market in America.
I don't want to say that there's a silver bullet. I think we look to Congress to do much more. President Biden has proposed a program that would lead to the construction of 2 million new housing units, which it would really make a sizable dent in the problem that we face.
Here to weigh in, we want to bring in Brad Case joining us at the desk. He's Middleburg Community's chief economist. And Brad, let's start there with what we just heard from Secretary Yellen when it comes to the fact that she said there's no silver bullet to addressing the nation's affordability crisis. Some of the policies that have been laid out by the Biden administration, are they helping at all? Why or why not, or what more needs to be done?
So, yes, I think what she's announced is a very good idea. You have to keep in mind two things. First of all, that the biggest driver of high house prices is a big increase in demand. And that's coming from several sources. One of it is just people moving out of living with friends and getting their own place. There's also immigration. There's a lot of migration to especially the Southeast. So demand is driving this growth in house prices. And the solutions really are mainly at the local level. So what the federal government can do is kind of limited, but the proposal that she talked about really does nail what the federal government can do. I think that will be helpful.
You know, it's interesting because demand is one component of it, but it's also materials. Those are higher. Labor, that costs more. You've also got more favorable land, especially as potential homeowners are looking at 15 or 30-year mortgage rates and trying to figure out, okay, what do I feel comfortable in terms of the property that I'm buying into, making sure that it holds up over that time when you're thinking about some of the hottest summers on record that we've been tracking over these past few here. So how is that all playing into the equation too from what you're tracking?
Well, when you think about the mortgage interest rate piece of it,
Yeah.
I mean, that's a situation where we're kind of stuck.
Okay.
Because yes, mortgage interest rates are high, and that's preventing some people from buying. It's also preventing a lot of people from selling because they're going to buy into a different house at a different mortgage interest rate. But at the same time, the house prices are very high, and that goes back to the demand part. So what's going to bring down affordability in the owner-occupied part of the market? If you bring down interest rates, all that does is make house prices go up more. And that wrecks affordability. What you really need is some moderation in house prices. And the only way to get that is supply growth. But we need supply growth on the rental side of the market as well as on the owner-occupied side of the market. And part of the reason for that is that we think that we're witnessing a shift among households to prefer renting for longer. And that's because, for the first time, they've had the opportunity to rent professionally managed, well-built, single-family houses. Instead of having to buy a house if you want 4 walls and a yard, you're able to rent it. And what that means is you're not being forced to buy into something that maybe you'll want several years from now. You're able to rent something that you want right now and then move into a bigger rental place or an owner-occupied house later on when it makes sense for you.
When should we expect to see some relief when it comes to pricing?
Well, we are seeing some relief. When you look at you showed the house price appreciation numbers that came out this morning. They're still very strong year to year. On the rental side of the market, rent growth over the last year has been very close to zero, maybe even below zero, depending on which part of the market you're looking at and which data source you're looking at. So that part of the problem really has been solved. But we need to continue developing more rental housing in order to make sure that rents don't creep up again because demand is still growing.
Whose fault is high home prices? I mean, millennials get blamed for everything these days. Is it our fault that we're not buying into homes that we can't afford right now, even despite family formation that might be happening or job relocation, whatever the factor, the input is?
No, I would say the real problem and the reason that what Secretary Yellen talked about yesterday is so important is because the fault is the cost of developing new housing at all levels, of all types, in all areas. But the result of that is that only the most expensive housing gets developed. We have to make it possible to develop. It doesn't need to be what we call affordable housing, with markets, with subsidies and that sort of thing. It just has to be housing for normal people, housing for regular people. And that is very difficult to develop, so it's only the most expensive things that get developed. And therefore, the price of the house goes up, even though the people don't want those expensive houses. What they really want is moderate houses.
Brad Case, always a pleasure to speak with you and get some insights and perspective. Brad Case, who is the Middleburg Community's chief economist, joining us here in studio, all the way up from Virginia here today. Thanks so much.
It's my pleasure to be here.
Certainly. Everyone, we've got all your markets action ahead. Stay tuned. You're watching The Morning Brief. You're watching Morning Brief, brought to you by Invesco. It seems Apple is calling all the shots. The iPhone maker reportedly rejecting Meta's advances to integrate AI chatbots into its smartphones months ago, according to a Bloomberg report. Now, the pair have not been in discussions about an AI partnership since March, according to people familiar with the matter. This is noteworthy because Apple has recently come out at its own WWDC and said exactly how generative AI was going to play a role in the next iteration of smartphones that it brings to market, or at least in the operating system for the most updated smartphones, where we're looking out to the 15 and above, essentially going to have those capabilities. So this is once again another instance where Meta Platforms, and back years before, a decade before, Facebook was trying to make sure that it didn't miss out on the wave of being able to tap into install bases. And that's where it got into the sharing of data practices, yada, 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 that came forward. And they never updated that over time. So this is another instance where they're trying not to miss out on the install base and the potential for generative AI or its software.
Yeah, and you can argue that this is potentially a huge missed opportunity here for Meta when you talk about the size of the install base, what exactly that could have done here to their business. So the fact that, yes, it sounds like they did hold talks, although that was extremely early when Apple had been holding talks with a number of companies to explore some of that integration within their models with their devices here. So again, the fact that, hey, it doesn't turn out or doesn't seem to be true, we're not going to see a partnership here, at least for now. I also wouldn't rule out, though, maybe some partnership down the line. What exactly that looks like, obviously, is up to anyone's guess, but it would make sense given some of the technology data that Meta has with its AI systems. Maybe down the road could make sense here for Apple. Never know. All right, we'll keep right here on Yahoo Finance. We got much more coming up ahead. We've got breaking consumer confidence data hitting right at 10 a.m. Eastern time. We'll cover that and much more on Catalyst next. It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst moving markets today.
Consumer confidence data is crossing the wires right now. That's going to give us a fresh read on how consumers are feeling about this economy. We're going to bring you those latest numbers as they come out here.
And Nvidia today leading the market higher, shares rebounding following a three-day sell-off that wiped $420 billion from its market cap. Now, that was the biggest three-day value loss for any company in recent history, according to latest data out from Bloomberg. We will discuss what this all signals about the momentum of the AI rally.
And the EU continues its focus on big tech, now charging Microsoft with antitrust violations for bundling Teams with other applications. This comes just a day after the regulator hit Apple with another charge. We're going to discuss what those charges in totality could mean for you and your tech investments.
We want to get to some breaking news out on consumer confidence data coming out now, coming in slightly higher than what the street had been anticipating, although it is lower, down from the previous reading in May, showing that consumers do remain concerned about the future right now, and that is continuing to weigh on confidence. And Maddie, this comes as prices, obviously inflation, we have seen some improvement, although overall remaining extremely sticky. It has been a pain point for millions of American consumers here over the last several months, several quarters here. So again, it is coming in slightly above expectations, but ticking lower from that previous reading.
Yeah, the confidence pulling back in June, but remaining within kind of that same narrow range. That's according to Dana Peterson. She's the chief economist at the conference board. I want to take a look, though, at that board that we just had up. Let's pull that up again so that I can check the broader market here. You're looking at gains still across the S&P and the NASDAQ. The S&P up over 0.1%. The NASDAQ up 0.6%. That's likely led by that tech rebound that you were talking about earlier in the show. We're seeing the Nvidia story kind of turning around here. Not as much movement so far off of this consumer confidence index coming out here, again falling to 100.4 versus 101.3 from the prior month. Shauna.
And also the median inflation expectations are important to point out within this note, coming in at 4.3%. That was following 4.4% the prior month. Consumer confidence expectations falling to 73 versus 74.9 last month.
Well, we're going to get to it with our next guest on what that latest data, alongside recent pressure in some of the big tech names, means for markets. Joining us now to discuss, we've got Sarah Malik, Nuveen, Chief Investment Officer, here with us on our stools. Thank you so much for coming in, Sarah. We appreciate it. That consumer confidence data doesn't seem like it's going to be a huge catalyst for the market today, so I want to dive in on the tech story. We're seeing Nvidia turning around a little bit here. What are the movements that you're seeing in Nvidia and even Bitcoin tell you about this market rally right now? What's the broader thesis you can drive from it?
The recent moves in Nvidia and Bitcoin are telling us that investors are becoming a little bit more cautious under the surface. I think there are cracks in the economy that we need to be concerned about, from weaker consumer data to employment markets that are starting to show signs of weakness. Nvidia, though, bigger picture, it's just back to its early June levels. If you look at it versus the semiconductor index, it's actually not an expensive stock. It trades at a discount to the index. So longer term, I think the AI trend is still in place. It's going to increase productivity for companies. But as of last week, tech was looking overbought. The amount of flows that had gone into the sector, the market had been up 8 out of 9 days in a row. It's time for a healthy bit of a sell-off in that area. But I think longer term, the fundamental drivers of Nvidia and AI are still intact.
So then should this be viewed as a buying opportunity, some of this recent weakness?
Well, it's hard to tell in these short-term swings in stock prices of where you would catch the bottom. Are you catching a falling knife? Are you really hitting the bottom here? We can watch technicals to try to figure it out. That's a bit tough. I think the catalyst for tech will be second quarter earnings, though, in a few weeks. If Nvidia can continue to beat that hurdle, beat the bar for earnings, I think the stock will recover. Until you get to their earnings number, though, is there a lot to say where's the bottom in Nvidia? That's tough because that's trading on momentum and investor flows right now.
So last question I'll have for you on Nvidia, at least, what settles this stock, right? What would be the catalyst to put it in a range that's a little bit more based on the fundamentals, based a little bit less on, seasonality and trends like the fact that we're heading towards the end of the month? What will cause the stock to just settle a little bit here?
What's been the driver for mega cap tech earnings has been quarterly earnings. If you look at first quarter earnings, tech drove earnings. So we need to get to those earnings numbers. You saw that last quarter with Meta, which put up very strong numbers. Even Apple starting to settle on earnings was the beginning of the rally for Apple. Nvidia, same thing. We need them to keep beating and raising, and people will then say, okay, this stock is worth more than where it's trading today. Until then, I think it can remain more in a trading range or even a soft because it's just trading on people's momentum and flows in and out of the tech sector.
Sarah, going back to what you just said a moment ago when you talked about some of the cracks that are starting to form within the economy, talk to us just about what exactly the signal or what signals that sends to investors right now, or maybe what investors need to keep in mind given some of the risk associated with that.
So two areas we're starting to become concerned about. That's the consumer and the jobs market. So first with the consumer, we've seen it in weaker retail sales data, fast food discounting, even retailer foot traffic starting to slow. Employment numbers have been mixed. So payrolls have been very strong, but if you look at unemployment claims, they're almost at cycle highs. I think consumer and employment goes together. When you feel secure in your job, you tend to spend more. We're seeing both of those start to break down. My view is that a recession is a when, not an if at this point. Are we at a recession today? Are we slowly? No, but we're slowly approaching one. And maybe fourth quarter of this year, first quarter of 2025, we will probably be in that recession.
I was going to say, so what exactly is going to be the catalyst? Because I think so many people have been a little bit surprised, or very surprised, quite frankly, just about the resilience here of the consumer. And even though we are starting to see some weakening, it doesn't seem to be drastic, I guess, up until this point. So what is going to change some of that?
Sure, the resilience of this economy in the face of higher interest rates and inflation has been surprising. Many investors thought 2023 would be the year of the recession, but now we're starting to see what needs to break down. The employment markets are the main catalysts that need to break down, and they're still reasonably healthy. And then the consumers needs to slow. I think consumers showing more signs of slowing than the employment markets, and that slow decline will be eventually what takes us into that recession. Now, of course, many hope that the Fed will cut rates in time to save us. I think the Fed will eventually start cutting rates, but I don't think it'll be enough for us to just stave off any form of a recession.
Does that indicate to you that the Fed is already too late?
Well, I think it's tough for the Fed because they're in a tough spot. They want to maintain their credibility by not cutting too early. They've been clear they will not cut interest rates until inflation shows signs of moderating and approaching their target. Just last month's inflation numbers were the first ones that were coming in under consensus. We need multiple data points before they can cut. Inflation was just reaccelerating earlier this year. So if the Fed cuts too early and causes reacceleration of inflation, we have another problem. So that's a balance for them. They need to cut in time to save off, try to minimize the impact of a recession, but also make sure they don't cause inflation to pick up again.
You know, I'm curious what you make of the inflation trend that we have seen, because Treasury Secretary Janet Yellen was on with Jennifer Schomburger on Yahoo Finance yesterday, saying that she remains confident that we're going to get to that 2% target next year. Is that realistic, or I guess how does the Fed then balance what you're talking about, the tough spot that they've been put in? They don't want to cut too early and risk reigniting that inflation rate versus seeing enough progress but not waiting too late.
Sure, and I don't think we'll hit 2% inflation in 2024. We do have a chance of getting there next year. It's going to depend on some of these areas like autos, which have been inflationary, healthcare insurance. Also in the PCE number this week, we'll see financial services, which will likely remain strong within inflation because of the market rally, which tends to inflate that number. So the Fed has to balance that, but also what's the economy doing. So you could see them start to cut before we hit 2% if the economy weakens enough, and that's going to be their balance. You know, what is the economy doing versus what is inflation doing? What are the risks of cutting and reaccelerating inflation versus the risks of not cutting and causing a deep recession?
Is a recession a requirement for 2%?
I don't think it has to be a requirement, but I think it's most likely. I think the consensus view that somehow we get through this period of high rates, high inflation, and we just have this beautiful soft landing is kind of a tough one. The markets are pricing that in. That's where I think the challenge is. You're going into the second half of this year. While Q2 earnings should be strong, we do have to worry about volatility around the elections and the slowing in the economy. It's going to be a tougher second half than the first half.
Since you mentioned the election, we've got the debate coming up on Thursday. I want to get a sense from you how much you think that could be a driver of the market's ability to price in what the outcome could potentially be on November 5th. Do you think that events like the upcoming debate are going to impact the market's view?
I don't think a specific debate will impact the market's view as much as what are earnings doing for the second quarter? What is the next economic and inflationary data point? You know, markets don't like uncertainty. What is certain is we do generally know who our two candidates should be. In an election year, good news and bad news. Good news is markets tend to go up about 11%. We've already experienced that good news. Bad news is volatility tends to go up too. That's what I expect to happen in the second half of the year. And remember, this isn't just a U.S. election year. There are 77 countries going to the polls this year. That's 60% of GDP. So this will be a global volatility event. And we're already seeing that in places like South Africa, India, France, and all these other areas of the world that are already experiencing elections and seeing some volatility. But just one debate later this week, I think that's going to have less of an impact than PCE will on Friday.
Sarah Malik, great to have you here, especially in studio. Thanks so much for taking the time to join us here at the top of the show. Nuveen is a Chief Investment Officer. Thanks so much, Sarah.
Thank you.
All right, let's check in on Nvidia. It's actually moving higher this morning, gaining about 3.5%, recouping some of the losses that we've seen over the prior couple of trading days. The stock actually falling 7% yesterday, 13% overall from when after it briefly became the world's most valuable company earlier last week. So for more on this and where we head from here, we want to bring in Dan Flax, Neuberger Berman, Senior Research Analyst. Dan, it's great to talk to you. So when you take a look at some of the price action that we've seen surrounding Nvidia, lots of questions about whether or not maybe this is a start of some unraveling when it comes to the AI trade. But here we are today looking at gains 40 minutes into the trading day. What does that signal to you?
Good morning. I think Nvidia remains attractive with a 12 to 24-month horizon. Clearly, in the near term, I would expect the stock to remain volatile. The key longer term, though, is really this continued execution on their product cycles. You saw that with Hopper in the data center, Blackwell announcing Rubin for 2026. And so this execution on the product roadmap is really foundational to driving growth over the next couple of years. And the other important piece of the equation is really a vibrant ecosystem. They continue to attract developers who want to write and invest in the NVIDIA platform. And so we continue to like the name, but again, do expect it to remain volatile in the near term.
So if you're expecting it to be volatile in the near term, what kind of math and models should analysts, investors be looking at to suss out the degree of NVIDIA's success heading into the next quarterly earnings print here? Because I think there is a lot of confusion from the street about how to run the numbers on a company that is growing so quickly.
There are a number of factors when we model the company. We go through each one of their businesses. The most important one is the data center business, where you're seeing very, very strong demand for their systems. Also, on the networking side, growth is very, very healthy there as well. And so you're trying to balance healthy demand with, of course, supply, which is constrained. Now, I expect the supply chain, NVIDIA and its partners, to continue to make progress on improving supply over the next several quarters. But that is a gating factor when thinking about the July quarter results, which will get announced later or in August. But the key is, if they're able to continue to execute on the product roadmap, I think estimates will move higher over the next 12 to 18 months, and that can help support the stock and drive out performance.
Dan, what does this tell you? Does this tell you anything just about that broader AI trade, some of the excitement, euphoria that had certainly swept the markets here over the last couple of quarters? Has that narrative changed at all? Clearly, there's still reason, obviously, to be excited, but in terms of the leadership and who exactly is positioned best, has that at all changed?
The environment remains very fluid, but what we focus on is companies that have distinct intellectual property, ability to execute on product roadmaps, and really the ability to invest throughout what, of course, remains a very, very difficult period. NVIDIA, I think, remains very well positioned in the data center. In the mobile market, think about all the devices, cars, smartphones, of course, factories, all of these different environments, they require low power solutions. So a company like Qualcomm, as an example, is incredibly well positioned in terms of its intellectual property and product roadmaps. I think Apple has a very important role to play. We saw recently Apple Intelligence. I think they are setting up for an attractive product cycle ramp with iPhone 16 and iPhone 17. Microsoft in the data center, as well as Amazon Web Services, Google Cloud. These platforms are really about empowering other companies and individuals to be successful. And that's what we're focused on when we look for growth opportunities.
Well, speaking of growth opportunities, I know there's a theory from your house, Dan, that hardware is going to outperform software because creating software is going to become really cheap with AI as a tool in that space. If that does become true, what happens to the software trade, not in the next 6 months, but 10 years from now?
Software companies, and Microsoft's a very good example. Oracle's another good example. The software companies have to continue to innovate, to invest, to really help their customers transition into the cloud and leverage new tools and capabilities like generative AI to create value on top of what they're already doing. We're seeing early signs that companies like Microsoft with Copilot are doing just that. And so I think there's a very attractive growth opportunity in select software names. I do think the economy and some of the slower enterprise spending is having an impact. But the structural growth story in the cloud and the build out of artificial intelligence on top of that over the next several years, I think it remains intact.
Dan, let's talk about what is going on more broadly speaking within this space. Another regulatory crackdown here today, or back in the spotlight. You just mentioned Microsoft. Today we have the EU filing antitrust charges against a tech giant over its Teams bundling. My question to you is, the market doesn't seem to be too worried about this. Investors have seemed to brush off some of these concerns within the past. Does this signal, though, something a bit more worrisome or riskier here for investors down the line?
I think the EU discussions and engagement with Microsoft, with Apple, really with all of the technology platforms will continue. I think at times it will remain an overhang in a particular stock or the broader sector. The more important thing from my viewpoint is that these companies, while engaging with the regulators, they have to be a little bit more transparent in terms of how their businesses work, how their business models are evolving. At the same time, they have to innovate and they have to invest because the technology landscape is changing so quickly. So I continue to think Microsoft is attractive. They'll have to navigate the dynamics with the EU and other regulatory bodies. But that in my view, is a part of what all the platforms have to do. Navigate and engage while continuing to invest to drive growth.
All right, Daniel, we're going to have to leave it there. Thanks so much for joining us. That was Daniel Flax. He's a senior research analyst. Thanks so much. Now, Nvidia alone has been responsible for about a third of the market's rally so far this year. The big question, is that a bug or is it a feature of this market? Joining us now to discuss, we've got our very own Josh Schaefer, who reported on this for us. Josh, I know you've been speaking with sources about all of the movement that we've been seeing in Nvidia. What are they telling you about how to read this moment?
Yeah, I mean, market concentration is bad if you're a bear, and it's probably good if you're a bull, right? Is sort of the way I think you could simplify it down to that. And most people are arguing right now that it's a feature of this market. So BlackRock was out yesterday with a chart pointing out that the concentration that we've seen in tech and the gains that we've seen in tech over the last year has really been a feature of this rally, not necessarily a bug. You're looking at it here. S&P 500 tech is in purple. The normal S&P 500 is in light blue. And then your yellow chart there is the S&P 500 X tech. So if you didn't have all those gains in tech, the market wouldn't be up nearly as high. And I think sort of the takeaway from this chart for me is, yes, you can worry about it all day long, right? But at the end of the day, it's what's helping you, if you're an index investor, sort of get these gains. And it is part of the good part of the S&P 500. Ben Snyder at Goldman Sachs, who they've recently just upped their target to 5,600, he called it the beauty of the S&P 500, right? The fact that when large companies outperform, they can pull the index up for you. And those companies have had strong earnings too. So I don't think there's a lot of people clamoring necessarily that these big tech companies, the ones we're talking about, right, are rising for no reason. The earnings are coming up significantly. That's dragging the index up. And right now, people feel relatively solid about that.
Yeah, and there's also, and you also have this in your piece too, just about some of the number crunching that Mike Wilson has done over at Morgan Stanley, just in terms of when we do see narrow breath within the market, some of that future performance or gains that we have seen as a result over the next 3 or 6 months.
So the chief investment officer over at Morgan Stanley, Mike Wilson, had an interesting point on this. He said market breadth right now, he measured it based on how many companies in the top 500 are outperforming the index. It's at about 20% over the last month on a rolling 1 month basis, which is the lowest we've seen since 1965, about 60 years. So if you just look at that chart in a box, that's scary, right? There's not that many stocks leading. But he points out when we get below 35%, so when we get in this narrow breadth range, actually the returns for the next 6 months are about 4%. And if we went up 4% from here, would anyone really complain? Probably not, right? So essentially saying that it doesn't necessarily mean that the rally just sort of falls off a cliff, because we are in a narrow regime. There are different ways that you can get higher, right? And some strategists have argued that it might actually be the most beneficial scenario for the S&P 500 could be the narrow market rally continues.
So maybe it isn't that worrisome. Overall, we're making a whole to-do out of nothing is my whole
We got to talk about something, Shauna.
Yes, we do, always. All right, Josh, great stuff. Thanks so much. Well, coming up next here on Catalyst, we're going to talk some bullish calls on Disney and Gap, break it all down for you, as well as some of the other top trending tickers on Yahoo Finance. We're 50 minutes into the trading day. We'll be right back.
Time now for some trending tickers. Goldman Sachs initiating coverage of Disney with a buy rating and $125 price target, saying midterm growth will be driven by its content. And Sean and Goldman noting that the media industry is still in flux while shifting to direct-to-consumer growth, but saying, quote, competitive moats and high growth visibility give a name like Disney more room to run here. And Sean, it's interesting. I know you're going to talk about this too, but it's not just Disney. They're also being rated in terms of Comcast and Fox, and they've also got Paramount as well on the list of names here. But again, saying that the industry's in flux. However, they do see potential room for growth on adjacent businesses that are less impacted by cord cutting, and that is specific to Disney, Comcast, and Fox.
Yeah, it certainly is. And what struck me also about this note was the price target and exactly what they're coming out in terms of that bullish call here for Disney. He sees a 23% upside from their previous close, that price target of $125 a share. For Comcast, it's 14% upside. For Fox, 22% upside. So taking into account what you just said, just in terms of the fact that the media industry still is in flux as it shifts here, its focus on profitable DTC growth while trying to manage some of the declines that they're seeing across the traditional linear aspect of the business. They do see reason to be optimistic, and I think that has been really the debate here across the street over the last several quarters when it comes to so many of these traditional and now streaming players here, how they are going to have, or what the ability is for so many of these names to offset some of the declines within their traditional business and really focus on some of the growth or profits here that are coming from the streaming business and how to do that in a way that isn't spending too much. And I think that's a very, very tough line when they're trying to close the gap with a leader within this space like Netflix. When they have so much content, they need to spend. We've been seeing more and more bundling, and it looks like that is starting to pay off here, or could pay off down the road. But again, an interesting call here just in terms of why they are still bullish, or the fact that they are bullish on a Disney, Comcast, and Fox. And then, of course, also want to bring up that sell rating that we also got here from Goldman when it comes to Paramount. Very important to note as well.
Absolutely.
All right, let's take a look at Gap because shares are moving higher after TD Cowen upgraded the stock from hold to buy, raising its price target from $28 a share to $30. So not a huge move to the upside. We're seeing gains of just under 2%. The firm saying that the company's earnings growth potential is, quote, appreciated. And I think that has really been the story surrounding Gap, exactly what Gap is going to do in order to get that competitive advantage. Now, in terms of some of those near-term catalysts to watch, the analysts there highlighting Old Navy's improving product assortment, particularly surrounding that important back-to-school season, obviously very important for retailers across the board. Also, collaborations at Gap that are going to drive some of that cultural relevance, at least TD Cowen making that argument. So because of some of those near-term catalysts, they're using that as a reason to upgrade the stock to buy today.
Yeah, and it's not just Gap, like you mentioned. It's those other names like Old Navy. They're seeing some bullish signs ahead, to your point, with the product assortment. Also looking at Athleta, saying that they think the comp sales numbers are going to improve, and that's going to bode well for the second quarter of 2024, seeing trends in that period improving as the brand introduces newness and going against easy comps in the third and fourth quarters here. So again, not a huge price target hike, but it is indicative of something that the CEO has spoken about right here with you guys on Yahoo Finance, about just the product mix, the transformation that the company continues to go through in terms of its offerings, and really finding ways to meet consumers where they are with the types of apparel that they're really looking for. This call kind of giving credence to that idea from the executive suite as well for Gap. All right, well, Uber is also getting a bullish call this morning from Piper Sandler, the firm reiterating its overweight rating on the stock, raising the price target from $86 to $88. They say Uber is a sleeping giant. Now, this comes aside some additional big news for Uber, also expanding its deal with Aurora Innovation. That is in an effort to haul freight autonomously, and they expect that to be coming in later this year. Now, Sean, it's interesting because these were kind of former rivals in the space, so interesting to see them attempting to have this fully autonomous freight travel. This would be the first fully autonomous truck offering from both of these companies. Again, driverless truck offerings from Uber and Aurora, these rivals coming together to potentially push forward these self-driving trucks. Again, they're saying that could come later this year. Sometimes those announcements end up having delays, but that's what the companies are saying right now for their potential timeline. And this also coming after Uber had sold off its autonomous vehicle unit to Aurora back in 2020. They'd spent $1 billion on it, now restarting that relationship here, Shauna.
Yeah, and in a recent interview here with Uber's freight head of autonomous trucking, making some interesting comments when it comes to pricing, saying that Uber doesn't plan to lower freight prices on the route despite going driverless. Also saying that Uber had picked Aurora partly due to its safety record, obviously a huge focal point and top priority here for so many of these companies as we talk about this shift here to driverless. Now going forward, saying that no injuries were reported in the 7 incidents Aurora recorded since 2021, and also the fact that this deal really underscores Uber's shift from developing its own self-driving car to the more cost-effective option of opening its platform to other companies. It's something that some analysts have talked about in the past, just what exactly that opportunity looks like going forward. So again, this deal here between Uber and Aurora is really what seems to be driving the stock, at least today.
Absolutely. All right, well, coming up, we're going to have more from Yahoo Finance's exclusive interview with Treasury Secretary Janet Yellen. So stick around for more on that after the break. Treasury Secretary Janet Yellen shared her economic outlook in an exclusive interview with our very own Jennifer Schomburger yesterday. And she joins us now to discuss the takeaways. Jennifer, thanks so much for being here and bringing us this exclusive conversation. What stood out to you?
Good morning, Maddie. Thanks so much. That's right. Treasury Secretary Janet Yellen told me in an exclusive interview Monday that she doesn't see a recession on the horizon and believes that inflation will fall back to the Fed's 2% target by next year.
I do expect inflation to come down, and as we get into next year, I believe that inflation will go back to the Fed's 2% target.
Her outlook is more upbeat than that of the Federal Reserve, which doesn't see inflation hitting 2% until 2026, with central bankers only penciling in one rate cut this year. A big reason Yellen expects inflation to cool further has to do with housing costs, which have been running hot even as other prices ease. She's specifically pointed to existing rental contracts that haven't seen the drop in rental pricing that new contracts are seeing. She says she's confident rental prices will come down over the next year and keep moving lower, helping to bring overall inflation down. Meanwhile, she doesn't see a downturn happening.
I think we've got a good, strong economy. This is a 50-year record in terms of the strength of the labor market. Households, consumer spending remains healthy. Investment's been strong. I don't see the basis really for a recession in the outlook.
And as Americans struggle with the high cost of housing, Yellen rolled out new initiatives to help with affordable housing, including a brand new Treasury program that would allocate $100 million over the next 3 years to help finance affordable housing.
These are things that are in our power now with the tools we have that I think will be helpful, but I don't want to say that there's a silver bullet. I think we look to Congress to do much more. President Biden has proposed a program that would lead to the construction of 2 million new housing units, which it would really make a sizable dent in the problem that we face. But we want to use every tool that we have.
When asked whether tax credits should be used to get more supply of homes on the market, she pointed to the low-income tax credit, something that the House has passed and something that the administration is urging the Senate to pass. When it comes to the middle class, she pointed to a proposal from President Biden to offer a tax rebate for first-time homebuyers. Of course, there is still a glut or lack of homes of supply on the market, something when it comes to tax incentives that Congress is probably going to be able to be the only one to fix. Guys?
All right, Jennifer Schomburger, congratulations. Great interview there yesterday with Treasury Secretary Janet Yellen. Thanks so much, Jen.
Thanks so much, Donna.
All right, let's take a look at Oracle, the software company, warning in its annual report yesterday that a TikTok ban is going to hurt its business. Oracle provides cloud infrastructure services for TikTok. TikTok has over 150 million users here in the U.S. So talking about the significance, exactly the impact that this is going to have on Oracle. Some of those details do remain unknown. Oracle has not disclosed the details of its financial ties to TikTok, but back in April, this caught my attention. Evercore had estimated that if TikTok is generating sales of about $16 billion in the U.S. per year, keep with me here, it could be spending 3 to 5% of that revenue on cloud infrastructure, which would work out to anywhere between $480 million to $800 million. So a very wide range here, but that does put some numbers into context here just about the impact that a TikTok ban is going to have or could potentially have on Oracle specifically. And of course, we know that this has really been a top priority for the Biden administration, as well as former President Donald Trump have been very critical of this issue, although he has flip-flopped just a bit. But the Biden administration, President Biden signing a bill demanding that China's ByteDance does sell TikTok if it does want to avoid a ban in the U.S.
Yeah, and Shauna, to your point about the note from TD Cowen, also several analysts have mentioned that Oracle is heavily used by TikTok. TikTok using Oracle's cloud infrastructure to store and process U.S. data. TikTok is considered to be one of Oracle's biggest customers across several of these notes. One from Evercore estimating that the annual revenue coming from TikTok to Oracle could be anywhere between $480 to $800 million from TikTok specifically. So potential $800 million annual revenue driver for Oracle could be washed away if TikTok does get fully banned. Now, they could still use Oracle, particularly if they do get sold off. It doesn't seem like if there is a sale, there would be a huge push to switch cloud compute offerings for the company moving forward. So they could stick with Oracle moving forward, but the company warning that that is a potential risk to come, Shauna. Now, coming up, could China be pulling ahead in the space race? We're going to discuss the latest developments and what that means for regulators as part of Yahoo Finance's Space Race Week. That's coming up next. Are you intrigued by the final frontier? You're not alone. But the space race isn't just about landing on the moon or even tourism for the wealthiest people in the world. It has the potential to gather and distribute vast amount of data, and it could even be a manufacturing hub for your favorite products. We'll chat with advocates and enthusiasts about why space is a real investment destination. From Starlink's biggest competitors to the perils of space junk, we'll bring you top insights. Join us for Yahoo Finance's Space Race, Investing in the Final Frontier.
NASA was once the leader in space exploration, putting the first people on the moon. Now billionaires are heading the journey to the next frontier. Yahoo Finance is here to give you the latest on the billionaires leading space race. Starting with Jeff Bezos, he founded Blue Origin in 2000 with the mission to establish an industrial base in space. Because it's a private company, we don't know the true valuation of Blue Origin. But we do know as of 2017, Bezos was selling $1 billion of Amazon stock a year to fund his space ambitions. The company has also received billions of funding from NASA and other government programs and is now competing with SpaceX and United Launch Alliance for a $5.6 billion Pentagon rocket program. Blue Origin launched its first rocket-powered test vehicle, the Goddard rocket, in 2006. Since that first launch, it has seen over 30 test flights lift off, with Bezos himself, of course, going along for the first crewed mission. The second billionaire on our list, Richard Branson, founder of the Virgin Group. Virgin Galactic, the space-focused arm of the holding company, was founded in 2004 and is focused on popularizing space tourism. It's the only public company we'll be talking about in this video, with a market cap just under $300 million. The company just implemented a 20-for-1 reverse stock split in order to increase the per-share market price of Virgin Galactic's common stock to meet the minimum bid price requirement to stay listed on the New York Stock Exchange. On July 11, 2021, Virgin Galactic became the first space flight company to independently launch a founder of the company into space, with Richard Branson and crew going above the 50-mile mark on Flight Unity 22. Virgin Galactic's first commercial flight took place on June 29, 2023, when 3 outside passengers associated with the Italian Air Force took a 70-minute mission. Virgin Galactic already has sign-ups open for regular people to get on the wait list to fly on its spacecraft when more commercial flights take place. The company reported that over 600 passengers had already signed up, with prices at $450,000 a person as of August 2021. Last but certainly not least, our third billionaire is Elon Musk. SpaceX is just one of many companies the eccentric billionaire runs. Of course, he also heads X, formerly known as Twitter, and Neuralink. Musk founded SpaceX in 2002, becoming the company's CEO and chief engineer. The latest estimated valuation for SpaceX was around $200 billion based on a Bloomberg report. Musk's goal for the company? Reducing space transportation costs and developing a sustainable colony on Mars. SpaceX had a rocky start, with its first few launches failing, but has since seen success. In 2020, SpaceX launched its first crewed flight, becoming the first private company to place astronauts into orbit and dock a crewed spacecraft with the ISS. SpaceX is also extremely successful with its low-orbit satellite division, Starlink. Earlier this month, SpaceX launched its massive Starship rocket test mission from its development facility in southern Texas called Starbase. All 3 billionaires are years away from achieving their full space exploration dreams, but each launch gets them one step closer.
It's not just the billionaires racing to achieve new heights in space. The Chinese spacecraft landed carrying what they say are the first ever rock samples from the far side of the moon. Could China be pulling ahead in the space race? And ultimately, what does that mean here for the U.S.? Joining us now as part of Yahoo Finance's Space Race Week, we want to bring in Kelly Kiedis-Ogborn, of Space Foundation's Vice President of Space Commerce and Entrepreneurship. It's great to have you here. So let's just take a step back and talk, starting with the news of the day here today. We have China take an important step forward. What does this ultimately mean, though, in this race back to the moon, and where the U.S. stands today versus some of the other nations who have made significant steps?
Yeah, well, I want to thank you for having me. And it certainly is the topic du jour and the question du jour. I think that there is certainly this urgency and necessity around the moon, but I think it's also too important to remember that the moon is no longer just for countries. Intuitive Machines, for example, became the first private company to accomplish a lunar landing last year. And so lunar engagement looks very different now than it did during the Apollo era, because we are now having very real conversations about a cislunar economy and new scientific endeavors that surpass the once ultimate goal of national posturing or a show of technological prowess. On a basic level, though, nobody owns the moon. So instead of talking about regulation of it or pulling ahead or pulling behind, I think we should really look at the means of engagement. And one of the best records that we have for that is the current Artemis Accords, which has 43 signatories as of this month. which really lays out a common set of principles for peaceful engagement in outer space and really the role of international partnerships in achieving a sustainable presence on the moon. But I think your question is really an interesting one, because I truly believe that while history doesn't necessarily repeat itself, it does rhyme. And it is often difficult to decouple the birth of our space industry with how it began as a space race. But the paradigm we are moving into now has countries, companies, and private citizens engaging in space. And so that framework of thinking really needs to shift and evolve.
So Kelly, what should that look like, particularly given, I know we started the conversation talking about China, which is a country under leadership that we don't have a lot of visibility into consistently. So what can we be doing in terms of policy in response to other nations' efforts when it comes to space, given that we don't have a transparent look into the overall global goals that various nations have?
Yeah, I mean, so we are certainly at an evolutionary moment in space. You know, there's significant growth, significant demand, significant engagement. There's about 92 plus countries that currently have an active satellite in orbit. And so when you look at space operations, there's civil, commercial, and national security all sort of mixing in one pot, which really demands ongoing conversations about the regulatory environment and really space policy considerations. But from that stance, we can really only work with what we have and what we know right now, with keeping an eye toward other activities. So really understanding how we are engaging in space and where we need to regulate and put all of our efforts. And right now that's really launch, satellite operations, and human spaceflight. And so it's sort of a mixed dance of being able to do what you can do at the moment, but then also monitor. But a lot of space, you know, is commercial activities, but also it signals sometimes posturing. It's just hard to decouple.
And with regulation within the space sector was just up on the screen here just a moment ago. Kelly, when you look forward and you talk about how this space age right now is so different than what we have seen in the past, how do regulations need to evolve, or how have they evolved? And what does that tell us then about future growth or ambitions when it comes to space, and what is achievable versus what is not?
No, absolutely. So as I mentioned, there are the ways that we engage in space now, but there are also all of these future use cases that are not yet at a scale that should be examined for their regulatory implications in the future. So as you just showed on the screen, you know, right now the US has this sort of patchwork regulatory responsibilities across the US government, anchored in the Outer Space Treaty, but then the FAA, NOAA, and the FCC also regulates different aspects. So it's really looking at who has the regulatory authority and at what point in the value chain. And I think what is possibly the most challenging thing right now is that there isn't one coordinating body. And while agencies do have their processes for tracking compliance with guidelines, there really is no enforcement mechanism, which can create a bottleneck and ambiguity for the commercial industry, and also questions about how existing frameworks extend. I think one of the things that can be done is just let the technology flow to allow us to know what the regulatory and policy needs are going to be. There are arguments on both sides whether regulation is good or bad. I think at some point the government should put some sort of framework and guardrails around the regulatory aspect, because if you're going to create a scalable and sustainable business model, we do need this set of standards and norms that companies can engage with, especially as our mission sets become increasingly more global and increasingly more integrated within infrastructure.
All right, Kelly, we're going to have to leave it there. Thank you so much for joining us this morning. That was Kelly Kiedis-Ogborn, Space Foundation's Vice President of Space Commerce and Entrepreneurship.
Thank you.
Now, coming up, we're going to have all of your markets action ahead, as well as our key takeaways from the trading day. You're looking at gains in the S&P 500 at about 0.2%. The NASDAQ up 0.7%. You're watching Catalysts.
Nvidia shares are moving higher, up just about 3% today, now offering some relief following that 3-day slump that saw the tech giant lose about $430 billion in market cap. Now, we spoke to a number of strategists earlier in the show about the outlook for Nvidia, maybe what happens next with the stock. Here's what they had to say.
As of last week, tech was looking overbought. The amount of flows that had gone into the sector, the market had been up 8 out of 9 days in a row. It's time for a healthy bit of a sell-off in that area. But I think longer term, the fundamental drivers of Nvidia and AI are still intact.
I think Nvidia remains attractive with a 12 to 24-month horizon. Clearly, in the near term, I would expect the stock to remain volatile. The key longer term, though, is really this continued execution on their product cycles.
So I think overall, my takeaway from the conversations that we've had, not only with Sarah, not only with Dan Flax, we also spoke to Kenny Polcari last hour, and he basically said that, yes, the near term, it's likely going to be volatile. You've got a stock that's up 145% year to date right now. We are giving back some of those gains. We did see a drop of just over 10% here over the last couple of days. So with all of that taken into account, yes, it could be volatile, but hey, maybe this is a buying opportunity. And I think the real question is how this is all going to shake out when we are going to see any sort of bottom, because like we just heard from Sarah and like we just heard from Dan Flax, the bullish case in terms of the catalyst for what is going to keep that rally going in the longer term, that case remains intact.
Absolutely, Shauna. And I think my takeaway here is that the broader market is not going to weep over one individual stock, even if it's the stock that's contributed to a third of the market rally this year. We saw that after Nvidia's $430 billion sell-off, that's the entirety of a Netflix, a Home Depot, a Bank of America, the overall S&P was still down less than 1%. So perhaps the broader market is somewhat unbothered by Nvidia's drop-off, and that is potentially a way to quell investor fears about the concentration that we've been seeing. We also had a lot of guests today, Shauna, and I know on your earlier show as well, talking about the seasonality of it all, the fact that we are heading into the end of the month, the end of the quarter. We saw the Asian stocks were higher over the past couple of days. That could be an indication that this is just typical end of month rebalancing. You got to show your clients that you're getting a little bit of profits. Maybe you're selling off Nvidia to that end, but we're already seeing a return to the stock performance. So not a long downside story for Nvidia.
Certainly doesn't look like it.
Well, coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour. So stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, new housing data shows a deceleration in the upward trend of home prices. We'll give you tips to attain the best mortgage rate for your purchase decision. Plus, getting retirement ready, there are 5 important changes this year that affect your nest egg. We'll talk to an expert who will give you and dive into the changes and reveal how you need to prepare. Plus, it's summertime, and you're probably scrolling through social media looking at 10 different friends' European vacations. Well, it's not too late for you too. We'll talk to a travel expert who can give you the hacks to save time and money this summer. All that and much more coming up throughout today's show. But first and foremost, as we mentioned, we've got some new housing data out today. According to the Case-Shiller Index, the leading measure to help calculate housing prices in the U.S., home prices in the 20 biggest cities rose 7.2% annually in April. There's some good news and bad news there. The bad news, the housing prices have never been more expensive. The good news is that rate increase has actually slowed down from March. Our next guest argues that one way to deal with high prices along with high mortgage rates is to consider securitized loans when purchasing a home here. And for more, we welcome in Michael Bright, Structured Finance Association CEO. Michael, great to see you here in studio this time.
Yeah, this place is great. I'm coming here every time. This is wonderful.
Absolutely. We'd love to have you back anytime. All right, so first and foremost, as people are trying to digest the latest housing data that's come out this morning, you're continuing to make the case here for securitized loans for some of those potential buyers out there.
Yeah.
Why is that?
Well, securitization is actually something that happens in the back end.
Yeah.
So as a customer, you may or may not even know whether your loan is on a bank balance sheet or it goes into a bond or security, but chances are pretty good that it's going to end up in a bond and a security. That is why rates, you can get a 30-year fixed rate loan if you are in a country that only has banks. For example, like Europe and Asia, you mostly can get variable rate loans. They're not 30-year fixed rate, and they're much higher than where they are in the United States. What I would say to a borrower, to a consumer looking to buy a loan is, use a broker agent. Usually your realtor will have a relationship. They will shop for various options, and you'll probably get a loan at a lower rate than you otherwise would. Then they're going to tell you who your servicer is, and just work with that servicer, and that's the relationship you'll form over the course of being a homeowner.
How much of a difference are we talking about in the loan that you could get?
Well, it's difficult to know exactly, but I think if we had a country that didn't have any securitization whatsoever, interest rates would be, 2 points higher, 200 basis points at least higher. So right now we're looking at mortgage rates around 7 1/8. There's a psychological effect just because for so many years the Federal Reserve have been suppressing those rates and keeping them at around 3.5%. A lot of people are looking at the 7% and saying, oh my gosh, I got to wait for rates to come down before I can buy a home. That isn't something I would advise. I think 7% is still quite low by historical average. Mm-hmm. And if we didn't have, the bond market facilitating this, you could be in the 9-10% range.
What are some tips for those who are out there trying to reduce their mortgage as well right now?
Reduce their mortgage debt or just
reducing their mortgage debt, trying to figure out where lower mortgages are sometimes available due to securitization or even what their down payment consideration should look like.
Yeah, it's we have a very liquid market. For down payments, you don't need 20% down. You can get what's called mortgage insurance if you have less than 20% down. So you shouldn't be of the view that if you don't have 20% down, you're locked out of the market. But when you're making a home purchase, it really needs to be the right thing for you for the long term. So my advice to any prospective borrower or buyer would be, do you want to live in this home? Is it right for you? Is it right for your family over the course of, let's say, 5 years at least? If that's the case, then go ahead and buy. Don't worry about the interest rate. They're still low by historical standard. If you're just speculative buying, that's something I do not advise. I think that it's a dangerous place, and that's gotten us in trouble in the past.
I just want to end by getting your estimation or your kind of crystal ball outlook on where prices might continue to move. I mean, we were just diving into the Case-Shiller home prices deceleration that was marked in this most recent reading, at least. Do you think that'll continue here?
Well, I'm sorry to say that I hope so. Okay. Because even though I'm a homeowner, I really don't want houses to continue to be unaffordable for so many Americans. And we are at historic unaffordability levels. And really the reason for that is supply shortage. So we don't have enough affordable housing supply. This is mostly state, local level. There's a lot of regulation that limits how much affordable housing supply can be built. There's a national effort right now to fix this, but it is a slow-moving train. I hope over the next 5 to 10 years, we're going to be building more housing supply, and that'll alleviate some of this problem. But right now, there are just more people who want to own homes than there are homes available.
Michael Bright, who's the Structured Finance Association CEO, joining us here. Thanks so much, Michael.
Thank you very much. All right. Bye-bye.
Well, with home prices at highs and mortgage rates just under 7%, how can homeowners pay their loans off faster than that 30-year loan life? Joining me now with one key tip to help you pay down your mortgage faster, we've got our very own personal finance editor, Molly Moorhead. Hey, Molly.
Hi, Brad. My tip is this: one extra payment a year.
Okay.
You can do this by saving up all year and paying making that extra payment in December. You can do it by paying a little over 12 months extra. You can make biweekly payments. That will save money. This will take years off the loan. You'll build equity faster, and you'll save a ton of money in interest.
And so you can save on interest, but how much are we talking about in that savings on interest?
So first thing is, like, let's say you take out $300,000 mortgage, 7% fixed rate over 30 years. Mm-hmm. You're going to take, with that one extra payment a year, you're going to take 6 years off the life of the loan and save almost $100,000 in interest. That's, a college education.
Yeah, oh, absolutely.
Yeah.
So is there any reason then not to make an extra payment a year?
I would say if you're one of those people who locked in a really low rate, then you might consider, am I saving enough for retirement? Do I have enough in emergency savings? Because you could potentially earn more on that money than you could save in interest on your mortgage, if that makes sense. Mm-hmm. So, if you have a 2 or 3% mortgage, that might be a calculation. If you've bought in the last couple of years at these high rates, do it. If you can afford to do it, make that extra payment a year. It's just going to pay off so much.
And so one monthly cost included in many mortgage payments that home buyers may not be aware of is PMI, or private mortgage insurance. I mean, what is this? Break this down for us a little bit.
PMI is one of those costs that's just so annoying to pay every month, because it's an insurance policy that protects your lender if you default on your loan. And it's typically, sometimes it's less than $100 a month, sometimes it's a few $100s a month, and it will be canceled automatically after the first few years of your loan, when you get to 78% loan to value ratio. And that's a technical term, but it's basically what you owe versus what your home is worth. It'll be canceled automatically, but you can cancel it early. That's the pro move, is to stop paying it as soon as you can. And you can do that by getting a new appraisal. You can do it by refinancing, paying your mortgage faster, like we just talked about. Just there's moves you can make to just stop making this payment that's not helping you at all.
And so it sounds like it's possible to remove that payment. I mean, what is the most straightforward way to go about removing it then?
So 2 things I would say: you can just write to your lender and ask to have it removed when you get to about 80%.
Just back of napkin, just hit send.
You need to show that you're in good standing, you're current on your payments, all that. But then the other thing that a lot of people are doing, I did this myself, is home values are increasing really quickly right now. And so if you get a new appraisal and you can show your lender, my home has appreciated this quickly, I'm already at that loan to value ratio, then you could get it canceled and save, it's not a college education, but it's a gym membership if it's $100 a month.
Why not? Absolutely.
Yeah.
Thanks so much, Molly, breaking this down. Key important information for some people to know out there. Appreciate it.
Thanks, Brad.
Consumer confidence ticked lower in June as Americans say elevated prices, especially for food and groceries, weighed on their views of the economy. Our own Jennifer Schonberger asked Treasury Secretary Janet Yellen in an exclusive interview about the inflation that we're seeing in grocery prices, and here's what she had to say.
Well, I think largely it reflects cost increases, including labor cost increases that grocery firms have experienced, although there may be some increases in margins. Earlier today, I met with a group of CEOs, including the CEO of Target, and they explained and they've announced that they understand that households are struggling with costs, including food costs, and they have undertaken cuts in the price of bread, milk, diapers, other core purchases that are necessities for households. And I think that's to be applauded. I think that kind of thing is helpful.
So the Treasury Secretary there saying which companies she was speaking with, but are companies doing enough to help fight inflation? Joining me now, we've got Robert Socken, who is the Citi Senior Global Economist here. Robert, great to speak with you and get your perspective on this. Are companies doing enough to help fight inflation?
Thanks so much for having me. And it's a real challenge, as you noted. If you look at the consumer confidence numbers that you highlighted, people are feeling these price changes that we've had over the last several years. And even though food inflation is now running at relatively low levels, you still had an enormous increase over this cycle. And so the cumulative gain has been very high, and people are seeing that at the stores. I think right now, one positive thing is that income has been growing as well. And so as income has been growing and food inflation has cooled, that real sort of purchasing power of food has improved. And then two, as you noted, some companies are taking action to sort of help with these food issues. Secretary Yellen mentioned Target. You're also seeing some fast food chains starting to offer better value meals that could also aid in this issue. But it's a big problem for Americans. It's particularly a large problem for lower income households, which have more of their budget geared towards food. I think in particular they're feeling the strain from these price increases we've had over the last few years.
How effective do you think the value meals will be, as we've seen even more of them rolled out recently, in trying to make sure that consumers are able to have an option to offset some of those higher prices?
I think, especially if you see more adoption of these types of policies, it would be helpful. But as you said, in a broader sense, the bigger problem is that you've had large gains in food prices over the cycle, and really it's taking time for people to adjust to these much higher prices. And as I've noted, as we've gotten income gains, that real purchasing power has improved and is likely to continue to improve given that food inflation is still running at relatively low levels. So I do expect that the problem will feel less burdensome over time, but hopefully we will see more policies like we've seen from Target and these other fast food chains, because I do think, again, where you're seeing the most strain is in lower income households. And those types of policies, I think, would really help alleviate the pinch that people are feeling at the grocery store and when they go out to eat.
Yeah, one of the other elements within this conference, consumer confidence reading, was on the 6-month moving average basis, purchasing plans for homes largely unchanged, remained historically low in June, and home prices hitting new highs according to the latest Case-Shiller data. So this all compounded. Our own Jennifer Schonberger actually asked Treasury Secretary Janet Yellen about the work President Biden is doing to address housing affordability. I want to play the clip for you and get your response on the other side.
I don't want to say that there's a silver bullet. I think we look to Congress to do much more. President Biden has proposed a program that would lead to the construction of 2 million new housing units, which it would really make a sizable dent in the problem that we face.
So is enough being done to help make housing more affordable?
I think this is another big challenge. If you think about the two things that people probably care most about when it comes to prices, it's probably the price of food and it's the price of housing. And we have seen in this cycle a really challenging dynamic where demand for housing has softened from where it was earlier in the cycle as the Fed has hiked interest rates, but supply has been very low. And so that combination of still okay demand and very low supply has led to pickup in housing prices and very poor affordability. So I think what really has to happen is sort of twofold. One, more housing supply will need to come onto the market to bring the market into better balance. I think probably as the Fed starts to ease up on interest rates, you're going to see more supply flood the market. and that should help with some of that imbalance in affordability. And the second factor, as you noted, is there's a policy element here. More can be done in terms of affordable housing. I know there's an exploration in many cities about what to do with excess office space, if some of that can be converted into affordable housing or other types of housing to alleviate supply issues. These issues I think are front and center. And I think more can be done on the policy side, because I think going forward, even when the Fed starts to lower interest rates and more supply comes online, that's not going to fully alleviate the issues of affordability we're seeing.
Yeah, Robert, at this point, many of us have probably seen that viral video or some of the images of a former baseball stadium that was turned into housing. And so why couldn't we do that with some of the commercial real estate that's out there, or office real estate that's just sitting at this juncture? Robert, thanks so much for taking the time. Certainly appreciate it. Citi Senior Global Economist. Great to see you.
Thank you.
Coming up on Wealth, everyone, taking the pulse of mom and pop shops, we dive into the results of a survey to reveal the pressure points on small businesses. That's coming up. And looking for a deal for dinner? Mickey D's, the Golden Arches, McDonald's is launching a $5 meal deal today. We'll tell you what you can get. Plus, we're also going to dive into the 5 most important changes this year affecting your retirement. All that and much more when Wealth returns. A new Bank of America survey reveals small business optimism rose in May, but remains below pre-pandemic levels. Small businesses make up 99.9% of American businesses, making them an important gauge of the U.S. economy. Here to dig into the results, we have Raul Anaya, who is the Bank of America president and co-head of business banking. Raul, great to have you on with us. I think very often we forget just how large a makeup of the overall business environment small businesses are here. And so the read in on the pulse of small businesses, how would you describe it right now?
Well, first of all, thanks for having me. When you think about small business, they continue to create a significant amount of jobs in the national economy. And as our own data shows, optimism in small business did rise in May. But like you said, it's still below pre-pandemic levels. The other positive thing about this is, again, using our own internal data, we look at the inflow and outflow of payments within our small business accounts, which, by the way, have over 3.5 million small business clients. And the inflow to outflow ratio, which is kind of a proxy to profits, was actually up in May, and it's the highest level since March of 2023. So that's a positive sign.
Okay, and so all these things considered, as you're looking across what small businesses are telling you at this juncture, I mean, you're looking across the business rent inflation even that exceeding that of households. I mean, walk us into some of these data points here. I mean, especially considering where small businesses are trying to offset the inputs of costs that they themselves are seeing too and having to account for.
Yeah, during our study, we focused on two of the larger components of cost for any business, particularly small businesses, and that's rent and payroll. Rent continues to rise, and as you mentioned, rent inflation for small businesses exceeding rent inflation for households. It's up. When you look at all the total amount of payments for small businesses, through May, it represented about 9% of total payments. That's significantly up compared to what it was pre-pandemic levels when total rent was about 6% of payments. So it continues to be a large portion of their expense base and the amount of payments. We did see some geographical differences. Rent inflation for small businesses tend to be a little bit higher in the west region of the United States versus perhaps the South and the Southeast.
Okay, and you mentioned with regard to this, there's the other component of how much they're paying and the payroll considerations too here. I mean, where has wage inflation pressure continued to either persist, or where have we seen it start to perhaps decelerate a little bit for small businesses?
Yeah, look, wages continue to be a big component for all businesses, particularly small businesses. And there has been an easing of wage inflation. And when you think about all the job creation that has happened over the last couple of quarters, that has actually eased the pressure on small businesses. It's still up year over year. And as you mentioned, it has decelerated over the last 2 years. And right now through May, it's up about 2.5%. So that's a very manageable number considering where it has been historically.
You know, I'd love to end this with some actionable tips perhaps for small businesses. I mean, thinking about the cadence that we typically hear from some of the large enterprises who are publicly traded, and they give us their assessment of the macro environment. For small businesses that are also wading through a very similar macro environment, perhaps not at the same scale, but much of the same themes still holding true, how can they best anticipate and best position their businesses for an environment where they're waiting the same way that consumers are for rate cuts in some instances, or they're just hoping that there still continues to be resiliency on the end of the consumer?
Yeah, it's funny you mentioned that. We actually, a couple of months ago, we came out with our business owner report, and about 65% of our small businesses that we surveyed expect revenues to increase. So it's still very, very positive, about the same where it was a year ago. For mid-sized business owners, it's a different story. Almost 90% of those mid-sized business owners expect revenues to increase over the next 12 months. A couple of things, there are some concerns with inflation, with interest rates, the political environment, but most of these businesses continue to find ways to bring efficiencies to their operations, and digitizing their businesses, leveraging technology, leveraging digital is a key way of doing that.
Raul Anaya, who is the Bank of America president and co-head of business banking, thanks so much for taking the time here today.
Thanks for having me.
Certainly. Attention all shoppers, savers, coupon cutters. Amazon has announced the dates for its 10th Prime Day event, and we want to tell you everything that you need to know to save a little money here. Now, Prime Day, it's going to take place on July 16th and 17th, and Prime members will get deals across 35 categories like electronics, kitchen, beauty, and apparel. Prime itself costs $139 a year, and you'll need it to take advantage of these deals. Now, some deals are already available, and here's a glimpse of what you can get right now. Prime members who haven't tried Amazon Music Unlimited can get 5 months for free. You can also get access to shows, movies, and channels on Prime Video, up to 50% off. And of course, it wouldn't be Prime Day without sales on Amazon's own devices. Right now, you can get what the company says is its lowest price ever for certain Ring doorbells, Blink devices, TVs, and Kindle Scribe, among other things. Now, June 26th through July 15th, Prime members can also get coupons when they shop at Amazon Fresh physical stores. And for all the summer travelers out there, there are offers for up to 40% off of select trips with Carnival Cruise Line. We've got even more of a dive on some of those travel hacks for you later on, but that is for the savvy shoppers out there. All right, guys, coming up, another big deal. McDonald's has a new value meal for just $5. We'll tell you more on the other side of the short break. Consumer confidence levels are down slightly this month as Americans continue to show some unease about the state of the economy. This according to the Conference Board's monthly numbers. For more, let's bring in our own Rochelle Akufo, who's got the full breakdown on the Conference Board's consumer confidence reading. Rochelle, great to see you.
Good to see you too, Brad. So as you mentioned, the consumer confidence for June did come in lower than expected at 100.4. That's down from May, but roughly in line with expectations. Now, the index actually reflects a number of factors that go into how consumers feel about current economic conditions, also future economic expectations, looking at about 6 months to a year out, also their personal financial situation and employment conditions in keeping or finding work, and income as well, income expectations. Now, future economic expectations are often weighted the heaviest in this index, which is why we did see some retreat there. Now, as we look at the present situation index, that's based on consumers' assessment of current business and labor market conditions. Now, that actually increased to 141.5. And the expectations index, that's based on consumers' short-term outlook, as I mentioned there, that's for income, business, and the labor market conditions, that fell to 73. So you really have this balance of people feeling a bit better now, We're sort of keeping an eye on the expectations down the road and those sort of balancing each other out. Now, Dana M. Peterson, the chief economist at the Conference Board, who regularly comes on Yahoo Finance, she said that consumers expressed mixed feelings this month. Their view of the present situation improved slightly overall, driven by an uptick in sentiment about the current labor market, but their assessment of current business conditions cooled. Meanwhile, for the second month in a row, consumers were a bit less pessimistic about future labor market conditions. However, expectations for both future income and business conditions, well, that weakened, weighing down the overall expectations index. So worth keeping that in mind, Brad.
All right, so what are some key takeaways for consumers from the latest numbers here, Rochelle?
Well, it's interesting because when you sort of take a look out at the 6-month moving average basis, confidence actually continued to be the highest among the youngest, those aged under 35, and the wealthiest, those making over $100,000. Now, consumers' perceived likelihood of a U.S. recession, because we know we've been looking at these recession signals for a while, over the next 12 months, that also pulled back in June compared to May. And overall, consumers were positive about the stock market as well. Obviously, the rallies that we've been seeing this year, 48.4% expecting stock prices to increase over the year ahead versus those expecting either a decrease or really no change, things to sort of stay in the same range. Also, the share of consumers expecting higher interest rates over the next 12 months, that also dropped to 52.6%. Now, that's the lowest level since February. Now, something interesting if you're a retailer, I know you were talking about Amazon Prime Day coming up. Now, purchasing plans, let's break it down. For homes and cars, those were largely unchanged. But buying plans for most big-ticket appliances and smartphones, that actually ticked up slightly. But fewer, though, looking to buy a laptop or a PC. So definitely some nuances there. And something to keep in mind for portfolios, if consumers are feeling less optimistic about the future, we do tend to see consumer staples do better than discretionary items in terms of sectors, as people tend to pull back here, Brad.
All right, Rochelle, excellent breakdown there. All the latest info from the Conference Board's Consumer Confidence reading. Appreciate it, Rochelle. Well, looking for a deal on your dinner? McDonald's might have you covered. There's a new value meal at the Golden Arches, and it's available starting today. McDonald's, one of the latest fast food chains to add value items to their menu in an effort to bring consumers back into their restaurants. For more, let's bring in our own Brooke DePalma. I mean, Brooke, I remember the only lure that I needed back in the day growing up was just the happy place, the playpen.
The Happy Meals,
Yeah,
the toys.
the toys.
Well, yeah, let's push those aside. Now McDonald's is getting very serious about bringing consumers back in the door, especially after their latest quarterly report. So this $5 meal deal, it includes a McDouble or a McChicken, a 4-piece chicken nugget, a small fries, and a small drink. Now this comes after McDonald's did have a rough first quarter. We saw U.S. same-store sales jump slightly up 2.5%, but that was less than what Wall Street had expected. And so now it's hoping to use this $5 meal deal in order to bring consumers back in. And McDonald's is not alone, as you mentioned. There are others doing this. We heard from KFC back in April. They introduced a $4.99 meal. Burger King also introduced that $5 Your Way meal. And now McDonald's, the latest. We also had Subway US president last week with those $3 dippers. But here's how this needs to work, Brad. In order for franchise operators to really see a return on this, we need to see increase in guest counts. More customers need to come in the door because value menus don't necessarily increase margins. Investors are also hoping that not only does this increase guest count, but then when they get consumers in the door, the consumers are actually saying, hey, I'll upgrade this, or I'll get 2 McChickens or 2 McDoubles. I'll add more to my items or more to my ticket as well.
All right, I guess for all the people that are out there bulking and on the value menu items.
Exactly,
2 of them, dose. All right, let's also focus in here on California. One McDonald's franchise owner decided to close one location here. This has been interesting. So what did she say was behind this move?
Yes, this was Scott Roderick. He said that this was necessarily a reaction to California legislation, in addition to the landlord wanting rent per square foot, high property taxes, as well as mall charges. So he said that because of that California FAST Act that we saw go into effect on April 1st, that increased minimum wage from $16 to $20, he said that those were one of the factors, in addition to the others that I mentioned, that he had to make the difficult decision to close his location in San Francisco. Now, a franchise expert that I spoke to,
to, said, this won't necessarily impact McDonald's at large, given it's just one location. Of course, if we see multiple, say hundreds, then it'll definitely hit McDonald's. But this does affect the way that consumers think about the healthiness of the brand. Think about how McDonald's is doing at large when you see your local McDonald's close.
All right, Brooke De Palma breaking down and tracking all things the Arcos Dorados, if you will. Golden Arches, everyone there, that's the translation. Thanks so much, appreciate it. Guys, coming up, we're talking about what you need to know about the changes to retirement this year and how the latest provisions might impact your wallet. That's up next. Stick with us. Saving for retirement can be confusing. 59% of people who are not saving for retirement think they are, according to Principal Financial Group. And oftentimes, changes in the process could mean that you're losing out on some cash or benefits. So to break down what this year's opportunities mean for you, we've got Ed Slott, IRAHelp.com founder and CPA, here with us in studio. Ed's also the the author of the new book, The Retirement Savings Time Bomb Ticks Ladder. I guess it's the founder of ideas going into the book here as well. Ed, nonetheless, thanks so much for taking the time.
Great to be here, Brad. Thanks.
Absolutely. So let's dive into some of the changes that have turned into opportunities for this year for people who are saving for retirement. What is the top one that they need to be taking advantage of?
Well, the changes, the opportunities of things you wouldn't think of, taxes and inflation.
Okay, why is that?
Well, everybody thinks inflation is bad, and I get that because things cost more. But when it comes to taxes, inflation is great because brackets expand too, tax brackets. So more money can come out at lower rates. And the other opportunity now is the low rates we have now. We have historic low tax rates now. So the key to anybody saving for retirement is if you have an IRA or 401k, remember, those accounts are loaded with taxes. The only way you can get to that money is by paying taxes. So if you can get that money out now, because I'm worried about future higher taxes, we have debt limits, the laws may be changing. So anybody stockpiling money in an IRA or 401k should be taking action. That's what I call this retirement savings time bomb ticks louder. It's the tax. I call it a ticking tax time bomb. Say that 3 times fast.
Yeah, I don't wish to hear.
In your IRA.
Yeah. So timing is everything, and you talk about this in your book as well here. Yeah. I mean, timing looks different for everyone across generations and across what your actual target day funds might look like as well here. So what is the best way to really kind of run the calculus around your own timing? Where does the thought process need to begin?
One word. Roth.
Roth.
2 words. Roth IRAs.
Okay.
It's the best account ever created of all, not even just retirement, because it grows tax-free, income tax-free for the rest of your life and even 10 years beyond to your beneficiaries. So everybody knows it's the best account to have. The only question is, how much are you willing to pay to get it? And the price you pay is the tax rate, which, as I said, is very low now. So you talk about generations. Young people should only be doing Roth IRAs. Imagine if people my age, baby boomers, had the opportunity to start from $1 building a tax-free retirement account. All of their money is stuffed in taxable accounts. So imagine if you're starting a job or in a job and you have years, young people have time on their side. You should only be doing Roth 401ks at work where your money grows and builds and accumulates absolutely tax-free. Or Roth IRAs to contribute to a 401k anymore just for a deduction that you have to pay back at the worst possible time years later in retirement, not worth it anymore.
And so one of the other mechanisms that people are trying to really familiarize themselves with in the event that they are feeling philanthropic, qualified charitable distributions as well here. How can this help as part of the broader strategy?
Well, that's a limited population. It's a great thing to give to charity if you're charitably inclined. I never say give to charity to save taxes, because if that were true, you'd give all your money away, you have no taxes. Nobody's doing that. But if you're giving to charity anyway, the best dollars to give are your IRAs. And they have this provision, qualified charitable distributions. The only problem with it, it's limited. It's only available to IRA owners who are 70 and a half years old or older. But if you're in that age group and you have an IRA and you want to give to charity, that's the way to do it, because you can get your money out at 0% tax rate.
What generation would you say is the best equipped or prepared for retirement because of some of these strategies that can be employed right now?
Gen X, every generation, actually. I was going to say Gen X and the millennials, I guess that's Gen Y or whatever it is, because they have time on their hands. But the parents, the baby boomers or maybe grandparents, they have substantial accounts and they're in a position to do Roth conversions, get that money out at low rates, move to tax-free territory, and have more and keep more of their hard-earned money and even pass it on to their generations.
It's thought IRAhelp.com, founder and CPA and author of the book, The Retirement Savings Time Bomb Ticks Louder. Thanks so much for taking the time here with us today. Certainly. Oh, the places you'll go. Coming up, the state of travel. We'll break down why more Americans are planning vacations and the hot destinations that they're going to. That's coming up next. We've been keeping an eye on the travel sector this morning. The number of consumers planning a vacation over the next 6 months continued to increase, which is still above last June's level, according to the conference board. And shares of Carnival Cruise Line, one of the players in that industry, pushing higher on continued demand to travel. The cruise giant posting record sales for the second quarter. So far, 2024 has been a record year for cruise operators, with more consumers seeking out new experiences at affordable rates. So for more on the sector as a whole, I'm joined by travel expert Mark Elwood. Mark, great to have you here in studio with us today. Okay, so we got to break down what you would make of the travel environment this year compared to last year. I mean, if we're just to look at a few stats, TSA travel throughput, we're already eclipsing some of those marks from last year, which finally got past some of the pre-pandemic records that we'd seen.
I think if you take a moment and you think about May 2020, when it felt like no one was going to travel again, that TSA numbers were at sort of 1960s levels. It's quite mind-blowing how in 4 years we've not just rebounded, you're seeing rates of travel and cost rates way higher than 2019, which was already a record year. And we're not really seeing any slowdown. Even if there are headwinds in the economy, the travel business is crossing its fingers and saying, looks like we're not being affected yet, because people really want a vacation.
Where do they want to go? Where are they going?
Do you know what I think you're seeing? You're seeing a couple of things. I think you're seeing the greenback is still very strong. It's softened a little bit, but currency-based tourism means that the UK, where I'm from, the pound is dirt cheap at the moment, so it's a great time to go to London. If you want to go to Turkey, the lira is very weak, and even the euro remains quite weak. I think you're also seeing people think, do I go to the Med in the summer? It could be 100 degrees. Do I want to sightsee in 100 degrees? Heading a little further north. Denmark, Iceland, travel agents will tell you they're very busy this summer.
We're looking at some of the hot travel destinations this summer, and a lot of these international territories that we're looking across here, I mean, they're going to have different price ranges.
Totally.
How do you see that varying across income levels right now, too?
Well, look, you're always going to see there's a number of Americans with a passport is surprisingly small when you look at the data, especially compared to developed nations.
Which is remarkable. I mean, I also can't really say much.
Admit this. Go on, admit
because
this.
I just got mine
last
year, 2 years ago. Yeah.
So I think everyone means, oh, I'll do it next year. I'll do it next year when there's a trip. But you're going to see there's a lot of domestic tourism. I think Americans often don't realize. You look at the sticker shock of a price. Transatlantic prices are very, very expensive, but not necessarily the holistic cost of a trip. Because remember, if you're spending a lot to get somewhere where it's much cheaper when you get there, it might be cheaper than a local trip.
What are some tips for becoming a master traveler?
Okay, I feel like I'm going to be the Yoda of travel for you right now.
Bring it.
Well, what we want to talk about, we want to talk about flights, essentially, and thinking about how to book a flight. Have you ever heard that there's a magic time to book a flight?
Yes.
You heard this, right?
Well, I thought it was Tuesdays.
Yeah, like Tuesdays at 2 a.m. or Wednesdays. That is the zombie myth that will not die. It is not true.
Oh my goodness! All right, so I can close my tabs right now. Okay, all right.
You want to sign up. There's a lot of free services with paid tiers as well. Things like Going, Dollar Flight Club. They monitor flight prices for you. And the way to get deals today is to sign up for them. Click the routes you want to fly, and they will burp out an email to you anytime those routes are cheaper. So you don't have to set the alarm clock for 3 a.m. That rule is done.
Okay.
I would also invest in AirTags. You know, losing a bag, maybe you're forced to check a bag at a gate. You've got an AirTag in there, you can always say where it is.
Okay. Especially if you're traveling with equipment, golf clubs or skis or any of these things.
And it's interesting, you'll find, I just got a new Delsey suitcase, and it has a little AirTag hanger included in it.
Interesting. Okay.
So you'll see that too. So those would be my two big tips if you want to be a pro traveler. One is basically about never getting ripped off.
Right.
And one is never being the person. And remember, when you check a bag, use your phone. Take a photograph of it before it leaves your hands.
Yes.
Because you'd be surprised how bad we are at describing things we think we know.
Just lastly, while we have you, because color me surprised with this one. Costco as the travel hack.
Do you have a Costco membership?
Oh, I know people who do.
You should.
So, by the transitive property, I do.
Exactly. Use the account. If you go to Costco's website, you will see there is a tab that you've probably never noticed, and there's on all the warehouse clubs you'll find the same thing. They sell travel at discounted rates, especially if you're looking for hotels and flights together, which is great at a peak time last minute, because the way the pricings work, often cheaper, do not discount Sam's Club, Costco, any of them.
All right. Mark Elwood, great to have you here in
Pleasure.
studio with us. Appreciate your time talking all things travel. I mean, it's a fun time of year to talk all this.
Of course,
Any
anytime.
time of year. Yeah. Well, an estimated 13 million Americans are expected to jet off to Europe this summer, according to Hopper data. Now, if you don't have travel plans this summer, it isn't too late for you to book without breaking the bank. To discuss how you can still find travel deals this season, Yahoo Finance's very own Carrie Hannon is here with us. Hey, Carrie.
Hey, Brad, great to be here. Absolutely, it is not too late. But the hot areas, of course, Europe is smoking hot this year. People are rushing to get there. Some of it's Paris, the Olympics, London, so forth. But we're also seeing Japan is big. And one reason for that is that the dollar is so strong against the yen. So it's become sort of a bucket list place for people to get to. But so we see, and prices are cheaper than they were last year, for sure. They've come down. Gas is cheaper than it was a year ago, for sure. So we're seeing for people who are traveling domestically, you've got your gas prices down, airfares are great. But again, the key to it, Brad, is being flexible. And we've heard this before. If you can travel the last 2 weeks of August, that's going to be a good time. And it gives you time to book it right now and get some of the best advantages of that time gap in order to nail down some of these good rates. So if you can do that, even better the shoulder season. If you can wait till September, October, do that by all means. Set those track alerts. They're Hopper, Kayak, Google Flights. They'll let you know, like we've heard that you set in where you're going to go. They'll alert you for the lower prices. It's a great way to do it. Even Kayak has one, I think, called Best Time to Travel. So you say, I want to go to Geneva. And they'll say, well, go in October, Carrie. That's a good time to go. Prices are lower and so forth. So that's important. Don't forget about your loyalty points. Yes. All of those things, from hotels to airfares to credit cards, and make sure your credit card is one without foreign transaction fees. So those are really important tips.
What might be more expensive this vacation season relative to years past?
Yeah, no, absolutely right. The dollar is marginally weaker than it was, so it's slightly not as great as it was last year. Hotel prices are up about 10%, particularly in the crowded cities. So I encourage people, maybe skip Paris, go to Lyon, skip Dublin, go to Cork. If you can pick, off the beaten track destinations close to where you might want to be, but get those lower prices there. But because you're going to see high hotel prices in those cities. You also might see, just a general uptick in different expenses, like, hey, I want to go to the top of the Eiffel Tower. Well, guess what? Those have jacked up this summer. Yeah. So is going to the Louvre. If you're in Japan and going to Mount Fuji, you're getting a thing. If you're going to Venice, you're getting a charge to get into Venice. So there are entry points that, we're not talking a whole lot of money, but it can add up.
Interesting. Carrie, thanks so much for breaking this down. Some of those hidden costs that people need to be aware of, especially as they're going out on those vacations that they're well earned and deserved. Thanks so much, Carrie.
Thanks, Brad.
Absolutely. Everyone, let's do a final check of the markets with the few seconds that we have left here on wealth. We're taking a look at the Dow Jones Industrial Average right now. It is moving lower by about 0.7%. However, you are seeing fractional gains for the S&P 500. That index up 0.3%. And don't look now, or do. The NASDAQ composite, right now, it's up by about 1.2%, 206 points to the upside here as of right now. We've got a little bit of time left, a lot of time left in today's trading session. That's it for Wealth, though. I'm Brad Smith. Thanks so much for watching. You can get counted down to the closing bell with Market Domination with Julie Hyman and Josh Lipton. That begins 3 p.m. Eastern Time. You do not want to miss it.